Ladies and gentlemen, welcome to the SOFI stock earnings call live stream going across. I think we're in 7 different channels right now. But I'm joined here with the great and powerful Neil, Couch Investor. How you doing, brother? You're muted.
I am muted indeed. Doing well. Good morning to you guys. I know it's super early for you. It's literally lunchtime for me. So it's the perfect time to talk about SOFI.
Lucky for the morning streams for sure. Tevis, the fundamentals of investing podcast. How you doing?
Hey, doing good. Got some coffee ready to go.
And then we got the great and powerful Dr. Roy. How you doing?
Yeah, good. Excited for these. Should be a really good report.
Good report. So we have numbers coming out in 4 minutes. All 4 of us will be scouring to make sure that we get it early. We're hoping for beats across the board. Neil, I didn't get to see your predictions. Do you have your numbers off the top of your head in terms of what you're expecting for revenue and EPS?
So revenue, I have, I think 1.08 billion, and EPS around 13 cents. This is what I have.
That's exactly what I have. So we have like minds.
Well,
okay.
I hope it does better, because usually I'm under the numbers and they beat it. So hopefully they beat it yet again. Because if they beat that, it's quite a big beat for what Wall Street is expecting.
Also, I just lied to your face. I have 1.07, 1.072. But yeah, you're slightly more bullish.
It's fine. We'll let that one slide.
Yeah. Okay, so few minutes. Welcome everyone. We'll let everyone pile into chat. This is our Super Bowl. You know, we get this 4 times a year. It's always an exciting time to wake up early. I don't do it for many companies, but only Neil does for his lunchtime reports. I could do that. That sounds easy. But okay, in the next 2 minutes, we're gonna see if we triple beat or if potentially there was some shakiness with guidance. That's my biggest worry. Guidance is the one that I'm worried about, just because of the change from having rate cuts to potentially having no rate cuts this year for the Federal Reserve.
It would be great to get to hear them say, we are not expecting 0 rate cuts, but we're still raising guidance or keeping guidance as is for the moment.
Yeah, but then it's not a triple beat.
No, but it is much better than, I guess, what the market thinks they're going to say. So yeah, I'll take it.
I mean, even better would be we're raising guidance even though we think there's going to be 1 cut.
That could happen too.
Do you think they'll say that they expect 1 cut or no cuts?
I don't know that they'll say that. Probably an analyst will have to ask the question for that to be answered.
Okay. Some people get X. Some people scour the website. Tevis, last time you got it first, so I trust you. And then either put it up on screen or shove the report my way. Welcome, everyone. Everyone's pouring in. What an early morning. Hopefully it's a good morning. Fingers crossed. It's good weather where I am. It's potentially a good sign for SOFI. That sounded like I checked the stars or something. Which some stock investors like to do. No, okay. Let's see here. We should be getting it any second now. It's 6:59 a.m. People in chat trolling. Justin, triple miss. I don't know if it's going to be a triple miss. The stock is starting to immediately have an adjustment here. Just flew. It's just jitters.
Yeah,
Actually, we don't.
That's
Really
just the volume that opens up at 7 a.m. Eastern time. There's some platforms that don't do 24-hour trading, so there's always that volume spike.
mirroring.
Inline on EPS, 1.087 on revenue.
1.087.
So beat on revenue, inline on EPS.
1.08. That's what Neil expected. That's, I think, 40 million higher on revenue and 12 cents of EPS. Okay. Revenue is up 41% year over year, and EPS is up 100% year over year.
And the stock is crashing.
So,
Not
so
really
you,
crashing. But
So you won't say I didn't say anything. I sent the link in the chat.
Thank you, brother. Okay, let's take a look. Revenue is up 41% to a record 1.1 billion. Adjusted EBITDA up 62% to 340 million. Member growth is now at 14.7. What is that? Roughly 1.1 million new members. Let's have a look. Total net revenue was 1.1 is what they're showing here. So even better than the report that I just read. Stock is crashing, dude. What is this on guidance or something? Here, I'm just going to skip directly to guidance because this must be. In the second quarter, management expects to deliver net revenue approximately of 30%, adjusted EBITDA margins approximately 30%, and adjusted net income margin of approximately 12 to 13%. The net income margin is really low, but full year for 2026, management expects to increase total members by at least 30% year over year. Deliver net revenue of approximately $4.65 billion, which implies a 30% annual revenue growth. So yeah, they didn't increase guidance, it doesn't look like. So they're kind of in line on guidance and they're in line on EPS. It's one of the less satisfying quarters that we've seen from SoFi. But
yeah,
I've only started going through it. $8.3 billion in originations for personal loans, $2.6 billion for student loans, and $1.2 billion for home loans. That is insanity. $12 billion in originations. Okay. What are you guys seeing so far?
yeah, we'll have to look over everything, but it's kind of in line, a little bit higher on revenue than I was expecting, in line with what I was expecting for EPS. Guidance is a little bit surprising just because of characteristic sandbagging, but I guess that's to build up enough margin that if you go from 2 cuts to none, that's where we're at. But yeah, the reality is we are, they're launching and issuing a lot of new products, which can drive revenue, but not necessarily drive EPS. And so I think that's the quarter we're seeing. I think when Tevis and I were talking about this, we were seeing this as probably the softest quarter this year just because of those things.
Okay. Can you check the tech platform revenue? What the heck happened there?
Where's the tech platform?
It's down 27%.
Yeah, it's because of Chime.
Well, it's Chime.
So still okay.
Yeah, because it's year over year. So that was sort of the weird thing where they said, "Hey, we're gonna have 20% growth." Yeah, dude, 75 million on the tech platform. This sector is dead.
Yeah. No, that's. I mean, I had a lower number. I was like, hey, they might do 100 million. But like the 122 is weird because it included the 33 million from Chime. So you're removing that number and all of Chime's normal revenue, but you're onboarding these clients. They may have onboarded like late in the first quarter, so they might not see that full revenue. But that's a platform that's dead.
Yeah, well, they said 20% growth pro forma. Like they're not. It was going to be much lower, but this is really low.
Yeah, the accounts is up, but the revenue's not there.
Yeah. Stock is trying to return here. Well, I mean, we're down 6%, but at one point we were down like 8.8% on the stock. Could be some of that tech platform. I don't think that they educated the investor very well in terms of how bad it was going to be. Like, you kind of left that up to surprise to the downside. Like, even all of us, we didn't expect that. So I think that was poorly communicated. And they didn't break down their guidance via their 3 sectors here. Let me see if we have the press release, or sorry, the actual earnings presentation.
Yes, it should be up.
Yeah. Okay. Perfect.
They included some new slides, which was nice. On the unaided brand awareness and on the new products.
Okay.
2026 relaunch for technology solutions. Huh.
2026. Oh, they hit 10% unaided brand awareness in Q1 of 2026. All right. 72% rule of 40, third highest they've ever got. That's pretty crazy, actually. 31% EBITDA margins, 41% growth rate.
Yeah, it's really good revenue growth. I know that a lot of people react just to the stock price, but it's not a strong, ridiculously strong report, but it's a very good one.
Yeah, no, I didn't even say it was a weak report. I just said that this is probably their weaker one, considering that we were in line on guidance and in line on EPS. That breaks their triple beat streak,
It does.
which is unfortunate. But what I imagine for guidance is that they're going to talk about going from 2 rate cuts to no rate cuts, because that was the exact same commentary at London Club.
Did you guys see the 2028 numbers
This year?
on slide 10?
Yeah. What about it?
7.89 billion and over $1 in EPS.
Yeah, but this is that's the exact same that they had it last quarter.
Really? I thought
Yeah.
they increased it.
Yeah, when they gave us the from it says 2025 to 2028, but Chris said it's not including 2025.
Yeah.
Yeah, they didn't give us a visual, but if you did just added the 30% CAGR, it'd get you the same number. Where's fee-based revenue? Did they show a slide of that yet? Fee-based revenue, year-over-year growth of only 23%. What? Like, how is that possible? How are we growing fee-based revenue slower than adjusted net revenue? This was a huge lending quarter then. That doesn't even make sense to me.
Why would they do that? They just choose to originate on them by themselves as opposed to, or is there any cyclicality in the LPB deals?
My thesis, although I backed away from it initially, was with the weakness that we saw in private credit, that perhaps they were wanting to have SOFI originate fewer loans while they were trying to figure that out. Now, the new originations that we saw, or not securitization agreements about a month ago, I thought, well, it looks like the demand is there, but it could have been that they said, hey, let's do less of this, and as a result, SOFI took on more. But I don't know. That's only guessing.
It could be like macro as well. I mean, reflecting on the demand for LPB. I'm sure that's how analysts are going to take it. Maybe they're going to get asked on the call.
Well, this is weird too. Like, I don't know if they said separately where their fair value, like they're showing where their fair value mark is, but they're not showing what the sale execution level was at. Which I don't even know why they made this slide. If if they're like, are you showing that you underperformed this quarter? Where's the Q1 sale execution? Which makes me think that it was below fair value marks, which actually goes to the comment that Muddy Water said about saying, hey, their fair value marks are too high. So this was the slide that countered what Muddy Water said, because they could end up selling their loans for more than what they were marking their loans down at. But where's Q1? I don't know. The student loan growth here is actually insane. Like, student loans skyrocketed. We did more student loans this quarter than in 2022, which is nuts. Also, $2.9 billion in loan platform business. That is crazy. $2.9 billion in a single quarter. Almost $3 billion. That's huge. Home loans doing very well this quarter, larger than 2022 and 2023 in terms of overall originations. What else are you guys seeing? Tevis?
Sorry, I'm just looking into the LPP side of things being somewhat softer, at least in the first quarter. Yeah, funding base continues to go up. Net interest margin, EBITDA margin went up as well. Yeah, kind of a mixed quarter in a lot of their numbers. And that doesn't mean that they're not growing. They're just not growing necessarily at the same clip that they were before, against tough comparable periods, which is kind of to be expected, honestly. But yeah, it's going to be interesting to see what they say in the actual call.
Roy?
Yeah, so I was looking at tech platform stuff initially. The other part was the 90-day delinquency numbers are heading in the right direction, which is really good. Slide 39. So yeah, it's a good report on the top line. Questions on the biggest thing for me is the tech platform. Like, what's going on there, and what you observed as well with the fee-based revenue. So them opening up the lending bucket, like, that's great, and that's to be expected. But that is seen, and I think correctly, by the street on this.
Am I crazy? Sorry, Roy. Am I crazy? This is slide 31 for me.
I think that's page 31, because you're in the Adobe PDF. So the bottom right numbers.
Yeah, anyway, it's still 31. I think maybe I misheard you. 39.
39.
Yeah, okay. Go ahead. Sorry.
Yeah, no, I think that was pretty much it, though. So.
Okay, let's see what else. It'll take me a minute to, and during the call as well, to actually go through a lot of these numbers. But we'll have to hear from, Anthony Noto to see how he clarifies a lot of what the heck we're seeing, if they still plan to beat and raise on guidance, because that's the important part. Yeah, I'm surprised by the fee-based revenue growth, considering that we saw so much overall revenue growth. Like revenue actually came in higher than all of our expectations. You know, I think Roy maybe had the highest at 1.085 or something like this.
No, I had 1.1.
Okay, perfect. Well, then 1.1 is higher than my expectations, and that beat Wall Street's expectations. But the fee-based revenue side and how much they grew on lending is surprising to me. I don't know about you guys. Neil, what else are you seeing here?
I mean, disregard the stock price. 3 months ago, we were all quite happy with the guidance that they gave us, with expectations of 2 rate cuts. Now we're all expecting let's say 0 rate cuts, maybe 1, and it's still the same guidance. So I guess we're disappointed because we're used to SOFI beating quite comfortably. But all in all, this is still a very good quarter. It's not like guidance has been lowered or anything like that. Margins are, things are still trending up and to the right, which is still a good thing. Now, we do have some questions here, like that tech platform business. A year ago, they did tell us that in early 2026, we are going to see some contributions from
10
customers.
new customers.
That's not happening, I guess, right now. And yeah, we'll see. He did say when he spoke with you two, Tevis and Tanner, that he'd be disappointed if Q1 is the fastest growing quarter of the year, right? So if he can repeat that in the call, that's probably going to be reassuring. But I don't know if he's going to say it, but he said it during your conversation. So some questions, but all in all, it's still trending in the right direction with no really big red flags.
Did you guys see this? Lending segment, 53% year-over-year growth.
Yeah,
I had by far the most bullish numbers, and I was almost off by $100 million.
I had it at 525.
Yeah,
so,
I had 530, and they came in at 630.
Yeah, that's what I was expecting them to do last year, is to really open up but they didn't. This year, it's interesting that they did that, and I think a lot really depends on why they did. So if it's like, hey, we saw an opportunity here, we did the equity raise, and as a result, like this is what we're doing. This is the model that we're working with. We're going to continue this acceleration. Or if it's more like, well, we weren't getting as much revenue as we thought with the tech platform and the financial services platform, and so we opened up the lending bucket. That would be bad. Not terrible, but it would be a lot less exciting, honestly.
Yeah. And margin is the highest that we've seen all year. It's not the highest margin we've ever seen across lending ever. And once I get my spreadsheets going, which Tevis, honestly, I might have you take over here. That way I can start plugging numbers. And financial services, the margin fell. And actually, quarter over quarter, the actual revenue fell 41%. Even though that's where I feel like a lot of our actual growth has come from, has been from, well, SoFi Invest would definitely take a hit this quarter. That's for sure. Just like Robinhood missing their numbers, there has not been a lot of growth there. We do have a new crypto product. However, there's probably not a lot of excitement around that because we're sort of in a crypto winter. Where was the, let's see. How many crypto accounts did they end up opening? Did I pass it? I might have passed it.
It's on the breakout slide, not the slide deck itself. It might be in the slide deck too, but yeah, crypto accounts are right under 240,000 as of March 31st.
240,000 crypto accounts?
Mm-hmm. Or products, yeah. Financial service products.
Wow. That's a lot more than I thought it was going to be.
Yeah, that's they were giving some really good incentives for that. So even if somebody was not, I think that the goal was that they realized that they have maybe a little bit more conservative population. And so to get some to even try out the crypto product, they were giving generous incentives. Pretty common for this type of platform. And that's good for getting adoption. It's good even for revenue. It's not helpful for EPS initially. And that's just that depending on how they realize that cost. And it looks like they realized that up front. So that's one of the reasons why the EPS wasn't a beat. Probably not like the main reason, but it's a contributor there.
Yeah. There was definitely huge incentives to sign up to many of their products this time.
It's going to be interesting to hear how they talk about the tech platform rebrand. I don't know if you guys read it in the report. They're saying they're offering services for the tech platform across 4 or 5 different subsegments now.
Can you share your screen?
Sure. So yeah, so you have that slide on the relaunch, and then you also have this line item here. So in 26, we're going to be launching a new unified brand, SOFI Technology Solutions, offering enterprise clients products and services across a total of 4 platform businesses: processing, banking, core ledgers and services, payment hub, and risk and fraud. I don't know.
How's that different than what they offer?
What's that?
How's that different than what they offer?
Well, so I don't know if they're going to start sub-segmenting out the revenue by those pillars. That could be interesting to see. But yeah, I think they have to do something with the tech platform being like this and them expecting more growth in 26. Like, this sort of makes sense.
So I got some clarification. The reason why there's no, okay, so this makes a lot of sense. The reason why we're seeing a skyrocketing in personal loans, and the reason why we didn't see any the fair value mark or whatever. Where was that slide? This one. There was no personal loan sales.
Interesting.
So supposedly the execution of personal loans was inclusive of loan platform business and home loan sales of, direct home loan sales, but there was no personal loan sales directly from our balance sheet to other customers. So there's nothing to write there for specifically personal loans.
Yeah, and again, there there could be 2 reasons for that. Is it that there's no demand and appetite? Could be. Is it that SoFi is like, hey, there's a great opportunity here, and we have the room on our balance sheet because of the capital raise? Both could actually be true. So we don't know, and we don't know how much is true. So it's interesting. Yeah, a little different quarter. Like the top line number, a little bit higher than I think what we had, but the mix is what's very intriguing. So, and like for the record, I know a lot of people are disappointed on EPS too. EPS, like this is not a company that's optimizing for EPS. This is a company that's growing 40% year over year. If you have a company that's in full growth mode, you don't want them optimizing for EPS, because then that causes them to make choices, stuff like not doing things like, for instance, launching SoFi USD, launching big business banking, giving these incentives to actually grow the crypto platform. They'd say, you know what, we're going to optimize for EPS and just crush that. Where SoFi is in the growth curve, it's way too early for that. At some point, they will begin to do that, but not when they're growing 40% year over year. So if I had to pick a number just to come in even, it would be EPS versus revenue.
Let's quickly see. I wanted to I want to see exactly loan platform business revenue. Q1, $20.4 million from loan platform fees. Yeah, I think that's about what we saw. Yeah, so I think Neil is right. You need to back up. You need to see this company's growing at 41%, 31% adjusted EBITDA margins, which was higher than their like long-term number that they wanted to give. They said margins were going to get to about 30%. We're now at 31%, 40+% year-over-year growth. But tech platform sucks. Guidance is nothing to be excited about. Obviously, like Neil said, midterm guidance was good. We all liked it. But SoFi has made an expectation of beating and raising. And so, you set higher numbers internally in your head to be like, okay, well, if they're saying 60, then it's going to be 65 or something like this. And then whenever they're still on track to do 60, it's almost like a miss in my own head, But I know it's not. But it kind of can feel that way sometimes.
They didn't really raise guidance, though, did they?
No,
I don't see a raise here at all. Which is like it's fair with the rate cut situation that we're in, but this is like one of the first quarters I've seen them not raise guidance in like 20 quarters.
Yeah. Yeah.
Yeah, I think, going back on Friday when we were talking about this, Tevis, that you actually threw out that scenario of what if they don't raise guidance, and I was like, nah, they're gonna raise, and that's the problem. They've given us that expectation of like, oh, they're just gonna continue raise. They sandbag so much, even with going from 2 to 0 rate cuts. That's clearly not the case. So, but
This is
I'd
sort of the,
rather.
This is sort of the problem that Lending Club had. They said that it was all just because of rates, because they were expecting 3 rate cuts and now they're expecting 0. And so while they had such a great Q1 that they're really hoping for continuous momentum into the rest of the year, they just can't say they're going to raise it because that's a massive tailwind. So if we get reintroduced with the possibility of rate cuts, potentially those beats come back. And Anthony Noda said they can still achieve their guidance without those rates. And that's what he's saying he can do. But it doesn't make it easy on them. It's definitely not a tailwind.
I mean, the fact of the matter is this is a company that is now trading at a forward P of 28, growing 40% compounded midpoint until 2028. Guidance is still the same. Might be better if we do have some indications of potentially a rate cut.
Yeah.
Plus, they still didn't even talk during the earnings call, so we don't have that extra information. And lastly, I am willing to bet $100, maybe even more. If the stock was up 2% right now, everyone would be saying this is a good quarter. But since it's down, it's a horrible quarter.
It's not a horrible quarter.
Nope.
It's not a horrible quarter. It's just the thing that I'm bummed about is the breaking of the streak of beating on EPS and beating on guidance. It was such a great stat to say, but then again, Tevis and I used to be on the phone talking about this. So like at one point they're going to miss, not just go in line. There's going to come a day where SOFI misses and you got to be ready to continue to hold it even after that. If you're a long-term investor and you believe in the thesis. This is not even that.
And there's a lot of companies out there that will kind of know like, hey, we probably shouldn't continue to raise guidance just because people expect us to, but we're going to do it just to keep the stock propped up. I don't love that they didn't raise the guidance. I'm not saying that. But what I am saying is I would much rather have leadership that's going to be honest with us and say, hey, we always, I know there's this expectation of like beat and raise. This is honestly what we're seeing. And I would take that 10 times out of 10 over a company that's just like, what, we're going to withhold information like the poet of the world until we absolutely have to tell you. Like that infuriates me as an investor. So it is what it is, but I appreciate the transparency. So, and yeah, 40% revenue growth, man.
I think they still could have raised it, just a smaller raise than what they normally do. And they would have still been in the buffer because they're conservative normally. And so there's a margin there that it's not actually going to be as. Now, here's the flip side. If they did raise it just cosmetically, let's say, just to keep the streak alive, and then they missed next quarter, that would look way worse than them not raising it at all. So there's a flip side there as well.
Yeah, that's a fair point. I don't want them to beat just to beat, but I am curious if they are taking on more risk on the lending side, because the lending skyrocketed, like weirdly skyrocketed. And I wonder if that was to fill some buffers on the tech platform. And I don't think it's accounting shenanigans, but it might just be like business. Like, are they taking on more risk to make sure that they still hit their numbers and didn't miss?
So I think we can go back to the late December fireside chat report with Chris Lapointe, the CFO, and he talks specifically about the number of originations that they turn away that are just outside their credit bucket, that if they open that up slightly, that would be a meaningful driver. I don't remember the exact terms, but he talked quite a bit about that. And at the time, like what I thought that was indicative of is like, AKA, they knew that they're going to do the equity raise in December, and they also knew these type of comments. So I was thinking we would see this bump in lending in last quarter. We didn't. So it could just be as simple as that. But like you said, we would need. I mean, they would need to comment on it. Hopefully, they do. On like, is this to make up for the lack of demand elsewhere, or is this instead like, hey, this is what we expected and plan to do? Our CFO talked about it. This is why we did the equity raise. That's great.
Yeah. Yeah. Even look at the non-interest income on their lending side, $130 million. Like this was a record destroying quarter for lending. Originations were like, it's hard to put into words how big this was. This even student loans almost practically tied what they did in all of 2023 in Q1. If they keep on this path, 2025 was 5.5 billion. This year could be north of 10 billion in student loans. 10.4 billion. Home loans could be in excess of almost 5 billion. Like they destroyed numbers. And then on top of that, they still did almost $3 billion in the loan platform business. This is also why they can pay a lot for a customer, is because they can, like, if you get a loan from those customers, it's greatly pays back a lot of those losses there. Did they sell off another 90 million of student loans again, or personal loans?
They didn't sell loans, remember? Oh no, that was just one segment. You're right.
They didn't, but I don't know if that is the same thing. If you give your loans over to like a collector, is that like a whole loan sale? I guess maybe it could be considered that.
Yeah, I'm not sure.
But this is like for real, one of the things that happens whenever you dilute. Like whenever they raise capital and then we're like, hey, what are they going to do with it? Lending originations could have definitely been one of them. Lending segment growing by 53%. That could be one of the very strong ways that you can put that capital to work. It doesn't need to be for acquisition. It doesn't need to be for business banking or something like this, even though that was a product that was launched. Which to Roy's benefit, or to like a point that he highlighted, whenever you launch SoFi crypto, SoFi USD, business banking, at the start of those products, you're always going to have those J curves where those products immediately are affecting cost on the business and actually negative to EPS. But then hopefully, just like financial services, you eventually build your way out of that and you start to produce real profits.
Yeah, it's different reasons, but it's kind of the same thing as the Robinhood report the other night. There's other things going on with them too, but like part of it is they're launching and they're building a lot of stuff, including like the Trump accounts. It's $100 million cost. You don't get that back immediately when you launch a new product. But if you're a company that's in growth mode, and SoFi is growing over 40%. Like this is a much higher growth than most companies out there, especially this size. Robinhood, same amount of revenue. Growth is much smaller this quarter. Like this is not a bad quarter at all. But it's surprising, like that mix. Like one of the things going into this quarter that I was interested in, I had lending coming in slightly higher than financial services, and I thought, maybe there's even a chance that financial services surpasses lending. Completely different this quarter. Do you think that at this quarter, at some point, financial services will actually overtake lending in terms of revenue?
Yeah, it's going to happen.
Dude, after this quarter, this was a surprising quarter. Like financial services grew at 41%, lending grew at 53%.
Yeah, I think this
we've not seen that in 5 years.
Yeah, this quarter seems really fantastic for lending because the other segments sort of underperformed the norm. If LPB was stronger, then you would have had financial services completely, blow that out of the water. So I think at some point this year, probably Q2 or Q3, I think you're going to get financial services being the largest segment. And it's worth also calling out that, like, if we're looking for SoFi to diversify their revenue, away from just lending, then there's only a couple ways that they can do that. One is the loan platform business, and the other one is the tech platform. And every single quarter that passes, the weight of the tech platform gets sort of heavier and heavier for the other segments to carry for them to maintain their growth rate.
Bro, it's crazy. Tangible book value just keeps climbing as well. We saw a massive bump up because of the dilutions, but now you're just seeing just overall business growth continuing to push up tangible book value, which just allows them to lend even more. So it's going to be quite interesting to see how that helps their growth over time.
I mean, they were leaving a ton of money on the table, yeah, with the lending segment, like for a long time. Now they're just feeling more comfortable with it, and why not?
Well, take a look at their capital ratio. I know we're still at 21.3% total risk-based capital ratio. They're still leaving a lot of money on the table. Like,
which is prudent. Like, you don't, especially if you're going into an environment where it's like, okay, there may not be any rate cuts at all, and that's kind of the consensus right now. And you're not sure, given like the Strait of Hormuz situation is still not resolved. You wouldn't want to take on, like, it's fine to initiate more loans, but you don't want to go down as far as quality by too much and then get burned on the other side, especially when you're a bank, when you're a little bit more conservative as well. Yeah.
how are you guys feeling with the stock right now? Stock is down roughly 9%, $16.73. Do you think that that's a warranted move for what we're seeing here?
Well, yes and no. I think, like, regardless of where the price was previously, when you have a company that has a history of triple beats and then you don't have that, it's not too surprising to see a sell-off by some people. Now, the other thing is, I think SOFI is undervalued going into this, even if we had known this exact report. So, like, short-term, not too surprising. Long-term, it doesn't deserve to be under 20. It's growing. Look at the peers. It's growing 40% year over year. That's meaningful growth. It looks like it's durable. The nice thing about where they're positioned with these different platforms is that they can shift some around depending if they need to or not. But yeah, what about for the rest of you guys? Are you surprised by the reaction?
I mean, we are used to SOFI being green and then red, so I rather have it red now and then green later. But
Yeah.
you never know. It's a great start of a very big day today. But no, like Roy said, I mean, even going into this report, SOFI is undervalued, is now even more undervalued. Still a good report. The growth rates are still quite incredible. And I'll repeat it again, if SOFI was up now 3-4%, everybody would be happy on the exact same numbers.
And here's that quote from Crystal Point back in December at the Fireside Chat, the UBS. He said, right now we're turning down about 100 billion of personal loan applications coming through the platform every single year. So even if we were able to capture a small percent of that, 5, 10, 15%, that's a meaningful growth driver for just that business. And in addition, we'd love to expand beyond unsecured personal loans and offer other type of asset classes. But yeah, he talked about expanding this. I just thought it would be last quarter, not this. And here we are. So interesting.
Tevis, what does this price action tell you?
I mean, it doesn't really tell me much, man. SOFI trades down on 10 out of 10 quarters. Like when we reported last quarter, and it was genuinely like a 9 out of 10 or a 10 out of 10 quarter, we were still trading down. You know, like we were trading up in the pre-market, and then as soon as the market opened, we started trading down. So, and I think we even finished that day red, if I'm not mistaken. But my point is that it's very difficult. I mean, we're going to see what they say on the call. Generally, we get a couple of points bump on the call. But as soon as the market opens, you know, all bets are off, I think, because this is still very low volume in the pre-market, relatively speaking. So I'm not really looking too much in the price action. Like we've been here before.
Yeah, I do also think like the the retail investors that are potentially selling it off right now, it could be on tech platform, could be on guidance. I think Wall Street's going to be more paying attention to the health of their loans. If they're going to see a return on them having a largely increased amount of originations, like there's some things that I just think they're not going to care for as much. They knew tech platform was going to sell off. Potentially, they knew it was going to go down to 75 million. So hopefully it doesn't continue to sell off whenever the market opens. I mean, I'm sure we're going to open red, but just is it going to be potentially down 9% or even further whenever the market opens at 9:30? Who knows? Dude, I've been continuing to read about this potential SOFI Technology Solutions relaunch. Do you think that name brand is going to have strengths?
I don't think anybody cares, man. I think they just care about the numbers. I'm sorry to be that blunt, but like, you can name it whatever the hell you want. If the growth starts turning around, I really couldn't care. Like, I'd be so happy. And
Yeah, no, I'm not
conversely,
worried about you as the investor. I'm worried about the potential hotel chain or something like this, like knowing that they're partnering with a large bank.
same answer stands. I don't think the rebrand is going to do much to change the value proposition, and if that's compelling or not to the end consumer businesses.
You guys sound depressed. I promise you, I'm not depressed at all. Like this has been fintech this quarter. If it's not Anthropic related, it's going red seemingly. But
hey man,
we woke up at 6:30. That's what's happening.
Lemonade knocked it out of the park, so that's a little bit good news for this morning for you.
Yeah, there you go.
But I think that's only me and Neil that applies to.
Yeah, up 7 on Lemonade. But yeah, okay. Let's see what else we have. About 17, 18 minutes until the call. Another thing that was a little bit shocking, not just adjusted EPS for the quarter, but for guidance, was them saying they're going to see like 12 to maybe 13% net income margin, and then no clarification on why that is. And I'm just curious as to why it's lower this quarter than, lower next quarter than this quarter. Because this is from Q2 of 2025, but like Q1 of 2026 was much higher. Any ideas?
Yeah, no,
this is a
hopefully
tax
we're clarifying that.
Yeah, I'm not sure. Adjusted net revenue growth of approximately 30%. I'd have to even see what that is. 30% versus Q2, because is that showing growth versus this quarter? Yeah, probably. But not much. Okay, Tevis, can you share your screen? And then I will... I got to plug some numbers.
Sure. Can you plug the numbers on the call?
Well, I want to be able to try to bring up some things. That way I can... What are you even doing over there? Just share your screen. You're doing nothing. Just share your screen, brother.
I can share mine.
Perfect. Thank you.
All right. So yeah, just looking at this specific deck. Yeah, it's interesting, like on the financial services side, because revenue wasn't as high as we were expecting. This right here is a pretty huge change on invest products specifically. Again, this is not revenue, but products. A lot of that, and they do talk about and recap at the top of this chart, basically some of the incentives that they're doing. 1% match. They're trying to bring some people over to the platform. They're launching crypto. Crypto we saw is growing well as well. Whenever you do that sort of thing, unless you are amortizing the matching bonuses over a long period of time, it's not going to be accretive to EPS. It will help some with revenue as well, but yeah, all these areas are accelerating fairly nicely. Credit cards are actually going in the right direction, which is nice. A year and a half ago, we really couldn't say that. And this right here, of course, is my favorite. SoFi at Work, up significantly, 47%. Relay, not a revenue driver. It is part of the flywheel, but yeah, that's products is heading in the right direction. Revenue's not there, and some of these new products that they're launching, I think it's just the explanation as far as why, at least in part. But yeah, this one right here, no matter how you look at the tech platform, it's like, it is ugly. So we'll have to see. Total accounts is not as bad though. So this could just be as simply as, and they need to put some color in this. I'm sure that they will in the call as well. But what's going on specifically? Because they have some of the major clients onboarding in quarter one. So if it was just like, hey, it was late in quarter one, they're now total accounts, or those accounts are coming or whatever. Let us know what's happening with that revenue. That would be great. But yeah, AWS and fintech, this is not for sure.
Yeah, AWS.
Any other things you want to catch? Yeah, I mean, like that. That's yeah. That thesis has been dead for me for a year and a half. But the loan platform business has really carried this forward. So
yeah.
Anything else stands out to you guys that you wanted to?
Whoa,
highlight?
yeah. SoFi Invest skyrocketed this quarter.
Yeah.
Skyrocketed. 400,000, 430,000 plus accounts. We haven't seen that ever. And I don't even think we've seen half that ever.
Half of that is crypto, right?
No, crypto's a second different line item.
Oh, still
Oh, yeah, you're right. Oh, man. That is, yeah. Very interesting. Good catch. Yeah, it's right there. It's still early.
because I'm plugging my numbers. That's how I'm catching it.
No, it's a significant increase, and it goes back to incentives. So at least that's part of the reason. But yeah.
I mean, crypto is still tiny. It's not even $1 million, I think, that they made from it.
Yeah.
Yeah, no, it's not going to generate anything. Credit cards went to an absolute halt. Like zero new credit cards. They were growing like 40, 50,000 new credit cards this quarter, 400. And there's no letter after that. Literally just 400. That dried up quick. Well, Robinhood, gold cards are like skyrocketing in popularity. I'm not saying that as a bad thing. I'm just saying it's a difference in the same macro. It's a difference in strategy.
Yeah.
SoFi Relay added 633,000 new accounts. And SoFi at Work also had a really good quarter as well.
Yeah, at Work did great.
This was probably like the quarter with like the biggest, like usually SoFi has like you can almost catch a trend on like, okay, what are they doing with originations over time? What are they doing with financial services? And this one is sort of the one where I'm seeing the most like, okay, they've been adding 40,000 new credit card accounts every quarter, 400. SoFi Invest has been doing, 190,000 a quarter, 438,000. Like it kind of broke trend on a lot of their numbers so far. And I've just started here looking at them, but yeah, really, really weird numbers. Any other things that you guys are catching here?
Referred loans is up a lot too, 58% year over year.
Yeah.
Relay, that it is really interesting. Like, I wonder what is driving that, because that's a substantial increase. I mean, we've seen some of this progression anyway, but that seems like a step up as well. It's not a revenue thing for SoFi. They basically offer the services part of their flywheel. Probably not at much cost, but it is like a negative in isolation. So I'm kind of wondering what's pushing this. Member growth is really good too. Shouldn't be it's not too shocking when you see products growing like this too. But
Yeah, huge personal loan quarter. Oh my gosh. 165,000 new accounts this quarter. Like this quarter alone. 28,000 student loans, which is like one of the biggest quarters that they've ever seen. And home loans also very, very big.
And yeah, this is good too. We've kind of gotten used to just a little bit under 1.5 products per member. They added 1.1 million new members and 1.8 million, which would be a little bit north of 1.5 products, new products. Part of that, of course, is crypto. It's aided by crypto, but it may also be, especially with the interesting relay numbers, that flywheel is actually working a little bit better this year.
I'm going to try to get some growth rates on their originations here, if I can. But yeah, to put it into perspective for their originations, it is like stunning how much they grew. 50+%, 50.6% on personal loan originations, 11% quarter over quarter. Student loans is really high. They went from 1.8, like in the last couple of quarters, I'll read you the last 4 quarters of student loan originations. 900 million, 1.5 billion, 1.86 billion, and then 2.6 billion. So from Q2 of 2025, we were doing 900 million. Now we're doing 2.6 billion in originations.
And that's without further rate cuts.
Yeah, like that's crazy. If we do get rate cuts, SoFi is completely back on track.
Oh yeah. And like that's the reality is this is where we're at with the CME Fed Watch. Current target rate is 350 to 375. 84.8% consensus there. It's moved around. Let's see if I can zoom that in some. A fair bit. We a month ago, and this is why one of the things with the lending is a little bit surprising. Maybe SoFi was like, no, they're absolutely not going to raise. This is a overreaction. But a month ago, 22% chance of a raise instead of just standing pat. Now, we've shifted things to the point where it's looking at, some are saying, yeah, there's going to be maybe a cut or two. Nobody's saying a rate hike in the current environment. So, but yeah, a lot of movement, a lot more than you would expect going into the year. There's always things that can change these reports, CPI, PCE, PCI, and so forth. But we have the Hormuz situation too, and it's changed things quite a bit from the initial picture. So yeah, like you said, this is basically like 0 rate cuts are priced in, I think, for SoFi as far as both guidance and what people are expecting from the stock. So if we start seeing that inflation is coming back down, that it was just transient, I know we hate that word, the Hormuz situation is resolved, fertilizer, helium, and of course oil and gas start flowing again through that area, and we start seeing this rate cut probability going up, SoFi should do very well in terms of a business and also as a stock. So lit overhang for right now.
Yeah. It helps every single one of their product lines.
For sure.
So, and there's some impacts too, like interest income is better whenever rates are high for their SoFi Money products and everything like this. But overall, the lending products outweigh those types of downsides.
Yeah.
So yeah, we added 1.55 million new members. 1.055, sorry. 1,055,000. That was almost the exact amount whenever I looked at like all the YouTubers, like the average across all of us. I think that was the number that we had come to as an average. So growing that total member base by an additional 7.7% quarter over quarter. Products per member continuing to grow. We're now at 1.48. That's really, really good. Like a lot of these KPIs actually did very well this quarter. Like total originations, product growth, products per member, CAC costs. Like, it's not as bad as the stock is making it out to be. The stock's having a very strong reaction for a company that did 41% revenue growth quarter over or year over year.
Which is crazy because like Hood double missed and SoFi is down pretty much the same amount.
Yeah.
Considering they just didn't raise guidance.
Yeah. Like we didn't miss at all.
Yeah.
Again,
It is,
5 minutes, and then we'll have Anthony Noto explain and tell the market why they're all a bunch of idiots and why this is still an amazing company growing 40%, and the stock might rebound, and everybody's going to be like, well, maybe it wasn't such a bad quarter after all.
Yeah.
I wouldn't mind having a little bit of if this was a flat day, I'd be like, I get it. It feels like a flat quarter. I'm like fully balanced. I don't think we should be up 10% on this news. But to be down 10%, I think is a complete overreaction on the numbers that we're seeing here.
Yeah, it's like, okay, it's a flat quarter, let's say, but you're down 10% after the stock was already down 50% in the last like 3 months, right? So I think that's what.
Yeah, but year to date, we're still up 40%. Like,
I'm sorry, what?
or sorry, last 1 year, we're still up 40%.
I was gonna say.
I was gonna say that's
Yeah.
that
not
would be lovely.
Sorry. Full 1 year, 1 year report. Like, so you can always zoom out and be like, yeah, well.
So I think this tells us kind of that.
Sorry.
Showing up. They mentioned on the durable growth side. I don't know. This is a different wording. I'd have to pull up. But SoFi's diversified business model is built to provide strong growth through different environments. They're probably going to talk a lot about that, and that's probably why they opened up the lending maybe even more than perhaps they were expecting initially in December. That it gives them, going back to the reason for the raise, optionality. That there's a lot of different things they can do, including launching new products, which they're doing, lending a little bit more aggressively. No rate cuts. All right, they can shift one direction. Lots of rate cuts, appetite and loan platform business, or we go back into crypto, no longer winter at some point late this year. Focus on that, but whatever it is, yeah. The wording is always interesting to me.
Calls should be in 2 minutes.
Yeah, calls should be in 2 minutes. Here, a couple people said, so is anything bad here?
Tech platform, no guidance raise. Some of the numbers are kind of flatlining on the quarter. I mean, they're all like nothing's like horrible, but just things to keep an eye on.
Yeah,
tech platform's horrible.
And there's good news too, but the market's definitely focused on the tech platform because that was the main driver of the stock whenever it first IPO'd. But also, if you've been listening to us, like we've been saying, this is not.
It's not the thesis. If it was somebody's thesis, that probably broke this quarter, and they may be out. And I get
Steve
that.
might
like
be
when
out.
your thesis breaks, yeah. But I don't know why that would be your thesis in 2025, much less 2026. So
Correct. Exactly right. Are we joining the S&P 500 this year? Any of you?
probably still, yeah.
Yeah, probably.
Neil?
I don't know. How many opportunities do we still have left this year?
3.
3 special events anytime if there's acquisition.
But you need to close the gap before
The
next
market
one.
cap thing.
Yeah. So it's like $2, $3 to close the gap.
Well, I'm staring at the gap being closed, assuming that
The
the
other
price
direction.
didn't, if it was still 1836, I think we get there. But if we go down 9.5%,
I mean, next one's in June, right? So I think you're still fine, but I don't think the S&P committee would be too happy to admit them in when they're just like flirting with the gap. Like they should have a little bit of a buffer.
I mean, it's not like they've the best companies over the past 2 years with an SMCI and such.
Well, I mean, they did put in the amazing William Sonoma, so
That's true.
yeah. Got to have your coffee in the morning. Okay. Call is about to start right now. Ladies and gentlemen, good luck to all of us. It's going to be funny how much we're all smiling if this stock reverts from down 9 to flat or something. But yeah, Neil is right. The stock price drives a lot of emotion. And the quarter was good. Like 41% growth is bananas. Let's get started. The call just began. Here we go.
First quarter 2026 earnings conference call.
Mute up.
All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star followed by the number 1 again. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SOFI's first quarter 2026 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the first quarter of 2026 versus the first quarter of 2025. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we may make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I would like to turn the call over to Anthony.
Thank you and good morning, everyone. We've had a remarkable start to 2026. Our relentless member focus continues to drive innovation across our business, leading to our 18th consecutive quarter of the Rule of 40, with a score of 72 reflecting 41% revenue growth and 31% EBITDA margins. Notably, this was the second consecutive quarter that we have generated more than $1 billion in cash revenue. In Q1, we generated over $1 billion in cash revenue, consisting of approximately $690 million in cash revenue from net interest income and about $390 million in cash revenue from interchange fees, brokerage fees, technology and loan platform fees, and loan origination fees. In fact, in both 2025 and 2024, more than 100% of our adjusted net revenue was cash revenue at $3.8 billion in cash revenue in 2025 and $2.7 billion in cash revenue in 2024. Our durable growth with an acceleration in revenue growth and strong returns and profitability is fueled by our consistent focus on innovation and brand building. Our mission remains the same. We help people reach financial independence to achieve their ambitions, helping them get to the point where they have enough money to live where they want, have the size family they want, the house they want, the career they want, and retire when they want. Other financial institutions pick and choose the products they offer based on how much money they can make off of their customers. And as such, they don't deliver the holistic experience people need to make their ambitions a reality. That's why SOFI delivers the Everything Financial app with unquestionably the most comprehensive set of digital financial tools and resources to help our members get their money right. Our critical success factor is helping people spend less than they make and invest the rest. Savings is not enough. Saving will help you get by, but investing is critical to get ahead to achieve your dreams. In order to achieve this critical outcome, we must help our members borrow better, save better, spend better, invest better, and protect better. We cannot just offer the products that are the most attractive financially. We need to be there for our members, not just for the large financial decisions in their lives, but all the days in between. It's not just our opinion that SoFi is the best. We are hearing it from others as well. In March, we ranked #1 in the J.D. Power 2026 U.S. Investor Satisfaction Study for do-it-yourself investing. This award validates our approach to building our invest product in a thoughtful, member-centric way, and we're excited to now be helping a record number of members invest for a better future. Also just this month, SoFi was named the #1 U.S. bank by Forbes in their World's Best Banks ranking, beating out institutions that have been around for decades. As part of this comprehensive survey, respondents were asked to rate banks on a customer service, digital services, financial advice, and perhaps most importantly, trust. Our goal is to become a household, trusted brand name, so we couldn't be more proud of this recognition that we are building trust with our members. While we are pleased with these achievements, it's still day one and we are far from where we aspire to be. In fact, this recognition further fuels our drive. Continuous iteration and learning leading to innovation is the key to our success. It powers our growth and it strengthens our returns for shareholders. Over the past 8 years, we've grown members by more than 20x from 650,000 to 14.7 million members. In Q1, we once again added a record number of new members at 1.1 million new members, increasing total members by 35% year over year to 14.7 million. We also added a record 1.8 million new products in Q1, increasing total products by 39% year over year. We now have 22.2 million products. SoFi continues to accelerate with 43% of new products opened by existing SoFi members versus 40% last quarter and 36% in Q1 of 2025. This clearly demonstrates the effectiveness of our Everything Financial Services app strategy and our ability to build deeper multi-product relationships with members, which in turn will drive a higher lifetime value. Our strong member and product growth powered our revenue growth in the first quarter. Adjusted net revenue was ahead of expectations at $1.1 billion. This is up 41% year over year, an acceleration from last quarter's very strong growth rate. Our lending segment had a particularly strong quarter, generating $629 million in adjusted net revenue. Importantly, our net interest income and origination fees in the lending segment totaled $639 million this quarter. In total, we had our best quarter ever for loan originations at $12.2 billion, which was up nearly $1.7 billion from just last quarter and included record originations across personal, student, and home loans. Of the $12.2 billion in originations, $9.2 billion was for our lending segment and $3 billion was for our loan platform business. The development of our loan platform business over the last 18 months has allowed us to better meet the borrowing needs of more members. Our strategy for what we put in the balance sheet versus through the loan platform business remains guided by the principle that LPB loan originations reflect the incremental volume we would not otherwise originate for SoFi's balance sheet for a variety of reasons, including capital ratios, managing the overall growth of the balance sheet, and the credit profile of borrowers. In addition to being able to serve more members through these two channels, they also provide greater revenue diversification. For example, balance sheet originations provide very visible and recurring cash revenue generation through net interest income over the life of the loan. In Q1 2026, we generated $690 million in cash net interest income, which provides revenue visibility, further contributing to our durable performance and cash generation. But this also comes with default risk and capital usage over the same time period. LPB loans, on the other hand, pay the majority of cash upfront, but free up capital instantly and remove the credit risk for SoFi. Together, financial services and our technology platform generated revenue of over $500 million, an increase of 24% year over year, and representing just under half of our total revenue. Our financial services segment continues to deliver impressive revenue growth, up 41% year over year to $429 million. The technology platform segment delivered net revenue of $75 million, which was negatively impacted by the loss of a previously discussed large customer. Total fee-based revenue across our business was $387 million, up 23% from the prior year. In addition to delivering durable growth, we delivered strong returns and profitability. In the first quarter, adjusted EBITDA was $340 million, up 62% year over year. Our adjusted EBITDA margin for the quarter was 31%. Our incremental EBITDA margin was 41% as we continue to balance reinvesting in the business to drive long-term growth and profitability. Net income in the quarter was $167 million at a margin of 15%. Earnings per share were 12 cents or 13 cents on a constant stock price basis quarter over quarter. Finally, our tangible book value ended the quarter at $9.2 billion, up 83% year over year, and $7.21 per share, which is up 57% year over year. It is clear that our diversified business is uniquely built to deliver a winning combination of growth and returns. And we continue to invest heavily to make our existing products even better, to build new products to help our members get their money right, and to further strengthen our trusted brand name. These investments will power our durable compounding growth and drive stronger returns as we continue to scale. Let me now spend a moment discussing our brand building efforts, which are key to driving new members to SoFi, feeding our productivity loop and growth. In the first quarter, our unaided brand awareness rose to an all-time high of 10%. That's up 300 basis points from a year ago. This is a reflection of our ability to meet our members where they are with a message of financial empowerment. So far in 2026, we completed another successful season of TGL presented by SoFi, which recorded significant fan engagement and momentum. We also kicked off the NBA playoffs with the SoFi Play-In Tournament, featuring 6 incredible winner-go-home games that brought in nearly 20% more viewers than last year and set new records for social and digital viewing. We also expanded our talent partnerships, adding 2 world-class golfers to Team SoFi, Justin Thomas and Charlie Hull. Justin and Charlie are true winners who share our passion for helping people get their money right. Beyond our strong sports marketing efforts, we're engaging with members earlier in their lives so they can build a better future from day one. For example, this year we kicked off our Future Wealth Summit, a national campus tour designed to help college students navigate key financial decisions and plan for life after graduation. Students today are making some of the most important financial decisions of their lives without the guidance they need. We're excited to bring practical education on banking, credit monitoring, and investing to put them on the path to success. Turning now to product innovation, starting with crypto, which has been a key focus over the past year. We believe the crypto supercycle that is underway will completely transform financial services, enabling frictionless money movement. We are well positioned to benefit from this supercycle, given our unique position as a tech company that is underpinned by the strength and stability of being a national bank. This is why we've been building a strong foundation on which we can develop and grow multiple new products and businesses and realize the benefits of crypto and blockchain across our entire ecosystem. In December, we took a big step forward on this journey with the launch of SoFi USD. This made us the first national bank to launch its own stablecoin on a public, permissionless blockchain. SoFi USD is at the heart of our strategy to make it faster, cheaper, and safer for people around the world to move money. During Q1, we began minting SoFi USD, the next step towards building compelling use cases for the coin. We also formed an important partnership with MasterCard to enable SoFi USD settlement across their global payments network. This will create interoperability between digital assets and fiat currencies and eventually allow for the settlement of transactions 24 hours a day, 7 days a week, versus just during business hours now. This brings me to our new big business banking offering, which was officially launched earlier this month. Today, companies operating fiat and crypto are forced to use multiple providers and are left waiting days for transactions that should take seconds. As a nationally chartered bank, we saw a tremendous opportunity to bring fiat and crypto banking to businesses on a single, integrated, and fully regulated platform. Our big business banking clients can hold funds in regulated business deposit accounts with institutional-grade safeguards, move money and crypto in real time with API-driven payments, and convert fiat and crypto instantly through native SoFi USD mint and burn capabilities while maintaining reserves within SoFi's regulated environment. We will start with companies that are operating in crypto or crypto-adjacent industries, but as more and more companies look to operate across both fiat and digital assets, SOFI will be able to support those needs at scale, including on behalf of other large banks. Turning now to an update on SOFI Plus, our premium membership. Plus is positioned to be the best of every SOFI product, all wrapped into one member experience. On April 1, we relaunched SOFI Plus with significantly enhanced benefits to bring the best of SOFI strategy to life while making the product a pay-only subscription. With the relaunch, we expanded our benefits, which now include our highest APY in deposits at 4.5% for up to $20,000, 1% match on deposits into taxable SOFI Invest accounts, 1% match on crypto purchases, unlimited one-on-one sessions with financial planners, a boost on SOFI credit card rewards, and so much more. Overall, this membership can unlock well over $1,000 in annual value for a fee of just $10 per month, less than the cost of today's lunch. And we will continue to roll out product enhancements and expand our offering while also providing special member options for military members and young adults, as well as through our SOFI at Work partnerships. The initial results of SOFI Plus since April 1's relaunch have been incredibly positive. We have seen strong growth in new paying subscribers, and the vast majority of new Plus paying subscribers are existing SOFI members who subsequently take out an additional product after signing up for Plus. SOFI Plus is not only driving a recurring and visible cash revenue stream, it is enhancing the awareness of the significant breadth of SOFI products as an everything app, and in turn, driving greater cross-buy and increased lifetime value. I would encourage everyone listening to try our rewards calculator on our website to see just how much you can earn from SOFI Plus. Now to our tech platform segment. We entered 2026 with the most comprehensive set of capabilities we've ever offered banks, fintechs, and brands. Given the breadth of our products, which extend well beyond the capabilities we acquired through Galileo and Technisys, we will be launching a new unified brand and restructured go-to-market later this year. Over the coming months, we will roll out the new brand, SOFI Technology Solutions. The new brand reflects the more comprehensive set of products and services that we now offer enterprise clients across a total of 4 platform businesses. First, in processing, we continue to see strong momentum with our client rollouts on our modern cloud-based processing platform. We have 13 new clients that generated revenue in the first quarter that were not generating revenue a year ago, including successful implementations with fintechs and major consumer brands. We've built a healthy pipeline of additional customers and are excited to get more programs off the ground in the future. For example, in 2026, we're launching an expanded relationship with one of the top 3 telecommunication brands in the U.S. and a new program with a financial services firm in the short-term lending space. Our second platform, Banking Core Ledgers and Services, includes our modern banking core and the many turnkey API-powered solutions needed for banking-as-a-service offerings. In this business, we are about to take a major step forward. This summer, we will complete the implementation of our new core platform with SoFi Bank, our first scaled launch with a U.S.-regulated bank. This will serve as a launching point to bring our new banking stack to other institutions. For SoFi Bank, our new core process platform will integrate seamlessly with our payments, fraud, and card capabilities, and importantly, will support ledgering for stablecoin in day one. In fact, the modern core will serve as the backbone for our planned crypto endeavors. We look forward to bringing this new banking stack to other institutions and building the next generation of our digital application platform. Our vision for our third technology platform business, Payment Hub, is to provide self-serve payment options across every type of money movement, including stablecoins, that are faster, cheaper, and more secure. Our API-first approach makes it easy to connect to ACH, same-day ACH, wires, FedNow, person-to-person payments, and real-time payments. Partners can manage payment flows with ease, maintain compliance, and offer a better customer experience. And we'll soon add SoFi USD payment APIs to our big business banking offering. The fourth SoFi Technology Solutions platform focus is our risk and fraud platform. Within this platform, we currently offer 7 products that address transaction fraud, account identity verification, and account takeovers, including Galileo Instant Verification Engine for real-time API-based account verification, our payment risk platform for transaction fraud, and an identity verification service which covers advanced compliance and sanction scenarios. These products leverage our latest models, often using over 600 data points for a single decision. And we are launching additional products in 2026 to further bolster our risk and fraud offering. Turning now to innovation within our lending segment, which is driving record originations across all three loan categories. Starting with personal loans, which support our mission of helping members reach financial independence. With the SOFI personal loan, members can refinance absurdly expensive credit card debt held at other institutions so they can stop paying for other people's rewards and focus on their own financial well-being. During the first quarter, we originated a record personal loan volume of $8.3 billion, taking share from competition and helping even more members get their money right. We see significant opportunity to help more people refinance high-interest debt, and we will continue to innovate with new product features and leverage technology to improve the member experience. For example, we're rolling out our personal loan doc coach, which uses AI to validate members' pay stubs and other documents, streamlining the application experience and driving cost savings over time. We're also testing new credit model features that can leverage enhanced data pools. This has the potential to help us make even better decisions that potentially extend credit to more members in the future. SOFI student loans help more and more students finance their education while they are in school, as well as supports students who have already graduated by helping them refinance their debt at a lower rate. Student loans have been a great way to introduce the SOFI brand and what we stand for to members early in their financial journey. Over time, we'll be there as their financial needs grow, which is why the value generated by our student loan business extends well beyond the interest income we collect on the initial loans. In Q1, we had our best quarter of student loan originations ever at $2.6 billion. This is up 2.2x year over year, but our originations volume is more than just a number. In generating this volume, we help nearly 10,000 members finance their education so they can realize their ambitions, and we helped over 10,000 members completely pay off their student loan debt. Turning to home lending, which is an area I'm particularly excited about. We've been hard at work creating a fast, seamless experience for our members who want to purchase a home, refinance an existing loan, or draw equity. Even while the overall home lending market is stagnant, momentum has been building in this business. We set origination records for 4 straight quarters, including Q1, when we originated $1.2 billion in home loans. This is up nearly 2.4x from the first quarter of last year. Here too, we continue to innovate. For example, last week we announced a new equity line of credit experience, making it possible for members to access to equity in their homes through a seamless end-to-end experience all on the SOFI platform. Finally, we continue to see healthy growth in our tangible book value. We recognize there has been ongoing discussion around last year's capital raises and their impact on dilution. As we previously explained, these capital raises were opportunistic, with proceeds intended to be deployed across a range of opportunities. Based on our analysis, the capital raises would not be dilutive to tangible book value on a per-share basis. And this has proven to be the case. Our tangible book value per share increased 57% year over year to $7.21, up from $4.58 per share, and is up 3% quarter over quarter from $7.01 a share. This is nearly $340 million of an increase in absolute terms. As you can see, our financial results are being driven by continuous innovation that is providing real value to our members. We continue to focus relentlessly on driving innovation and developing products and solutions to help our members navigate all the major financial decisions in their lives and every day in between. We will continue to put our members first and help them achieve their American dream. Over time, the trust that we build with our members will lead to deeper relationships. This in turn will drive a higher lifetime value per member and will power our compounding growth and returns. With that, I'll turn it over to Chris.
Thank you, Anthony. We've had a solid start to the year. Our innovation and brand building is powering exceptionally strong revenue growth. In the first quarter, adjusted net revenue grew 41% to $1.1 billion. This is a further acceleration in the growth rate from the prior quarter. Importantly, we generated $1.1 billion in cash revenue in Q1, which includes approximately $690 million from net interest income and approximately $390 million from interchange fees, brokerage fees, technology and loan platform fees, and loan origination fees. Cash is defined and accounted for the same universally, no matter what type of company it applies to. In the first quarter, these cash revenue streams were nearly equivalent to our total reported adjusted net revenue. This is the first time we have disclosed our cash revenue, as we think it's a helpful financial measure to consider given the different accounting treatments companies use. As we mentioned, it's our second consecutive quarter of more than $1 billion in cash revenue, but I would also note that 100% of our reported adjusted net revenue was cash revenue in both 2024 and 2025. This means that the scale and seasoning of the loans on our balance sheet has reached the point where the upfront non-cash premiums on new originations are being balanced by pull-to-par and other mark-to-market impacts on the existing portfolio, leaving the vast majority of our reported revenue being approximately equal to our cash revenue. We have consistently said that over the life of the loan, there's no difference between fair value accounting and cost accounting, and we are seeing that play out in our reported results. In addition to our strong revenue growth, we delivered strong profitability during the quarter. Adjusted EBITDA was $340 million, up 62% year over year at a margin of 31%. Net income was $167 million at a margin of 15%. Net income was up 2.3x year over year. And earnings per share was 12 cents, which was negatively impacted by 1 penny due to a decrease in discrete tax benefits related to employee stock compensation given share price movement between Q4 2025 and Q1 2026. At a constant share price quarter over quarter, EPS would have been 13 cents. This was our 10th consecutive profitable quarter. Turning now to our segment performance, starting with financial services. For the first quarter, financial services net revenue was $429 million, up 41% year over year. Contribution profit was $196 million, up 32% from last year. And contribution margin was 46%. Net interest income for this segment was $228 million, up 31% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 55% to $201 million for the quarter. During the quarter, we continue to see healthy growth in interchange, up 54% year over year, driven by nearly $25 billion in total annualized spend across money and credit card. We also had record brokerage fee revenue, which more than doubled over the past year. In terms of our loan platform business, one of our key differentiators at SOFI is having both a very strong balance sheet and an established loan platform business, supported by a diverse set of partners that go well beyond private credit asset managers. In fact, during the quarter, we added $3.6 billion of new commitments with 3 new partners, including a leading global bank, a prominent insurance group, and a top 5 global private asset management firm. Our diversified model allows us to efficiently channel loan volume based on a number of factors, including borrower demand, capital levels, and credit risk, with a focus on maximizing risk-adjusted returns. Each channel we utilize provides benefits to our business. For example, our balance sheet lending generates stronger revenues over the life of the loan, whereas LPB generates capital-light fee income with no retained credit risk or loss share agreements. Having this optionality will allow us to generate more consistent growth through a variety of environments. Overall, during the first quarter, we saw exceptional demand from members, which is reflected in our record personal loan originations of $8.3 billion. Given our very strong capital ratios, we channeled nearly $5.4 billion of personal loans to our balance sheet and approximately $3 billion through our loan platform business. This deliberate decision resulted in lower LPB originations relative to the fourth quarter, although LPB originations were up 90% year over year. I would note that we had significant demand from LPB partners over and above what we decided to fulfill this quarter, but we did fill all demand from our contractual commitments and more. Turning to our tech platform business, where we delivered net revenue of $75 million in the first quarter, reflecting the exit of a large client who fully transitioned off our platform prior to year-end. Contribution profit was $12 million at a contribution margin of 16%. Turning to our lending segment performance, which was very strong during the quarter. In addition to record personal loan originations of $8.3 billion, we also saw record originations in student and home loans. Student loan originations were $2.6 billion, up 2.2x from the same period last year. Home loan originations were $1.2 billion, up 2.4x from the prior year. For Q1, adjusted net revenue for the segment was $629 million, up 53% from the same period last year. Contribution profit was $382 million, with a 61% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 39% year over year to $500 million, and the balance of the growth came from loan origination fees, which were up 36% year over year, and home loan sales, which were up more than 2x year over year. Capital markets activity was strong in the first quarter. We sold or transferred through our loan platform business $3.8 billion of personal and home loans. In terms of home loan sales, we closed $765 million at a blended execution of 102.1%. Additionally, we sold $89 million of late-stage delinquent personal loans in line with prior quarters. In addition to our loan sales, we executed a $919 million securitization of loans originated on behalf of our partners through the loan platform business. The transaction priced at an industry-leading cost of funds level with a weighted average spread of 86 basis points, our best execution for any securitization deal to date. To meet standard industry risk retention requirements, we contributed loans from our balance sheet that represented a 5% vertical slice across the securitization's tranches. Importantly, we do not retain any first loss or horizontal risk position. Turning to credit performance, our credit remains strong, performing in line with our expectations and driving attractive returns across all loan types. Our personal loan borrowers have a weighted average income of $154,000 and a weighted average FICO score of 745, while our student loan borrowers have a weighted average income of $161,000 with a weighted average FICO score of 767. For personal loans, the estimated all-in net charge-off rate was flat quarter over quarter and down nicely from a year ago. Excluding the impact of delinquent loan sales, the estimated all-in annualized net charge-off rate was 4.4%, which is the same as last quarter and down roughly 40 basis points from the first quarter of 2025. Including the impact from the DQ sales, the net charge-off rate was 3.03%. This is up 23 basis points from the fourth quarter, but down 28 basis points for the first quarter of 2025. The sequential increase was primarily a function of us maintaining consistent DQ sales of around $90 million per quarter, while our balance sheet grew at a faster pace. The on-balance sheet 90-day delinquency rate was 47 basis points, down 5 basis points from the last quarter. For student loans, the annualized charge-off rate was 65 basis points, down 11 basis points from the prior quarter. The on-balance sheet 90-day delinquency rate was just 10 basis points, down 4 basis points from the prior quarter. The data continues to support our 7 to 8% net cumulative loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originating from Q4 2022 to Q2 2025 have net cumulative losses of 4.64%, with 36% unpaid principal balance remaining. This is well below the 6.32% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by 9 basis points during the quarter. In fact, this gap has widened each of the last 7 quarters since we began measurement. Additionally, looking at our Q1 2020 through Q4 2025 originations, 61% of principal has already been paid down, with 6.8% in net cumulative losses. Therefore, for life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 39% of unpaid principal would need to be approximately 10%. This would be well above past levels at similar points of seasoning, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate, comprised of benchmark rates and spreads. These marks are developed alongside a third party, which feeds our actual loan level data into their proprietary model and are reviewed by our independent auditor as detailed in our filings. At the end of the first quarter, our personal loans were marked at 105.4%, down 27 basis points from the prior quarter. This was driven by an increase in the discount rate, which was due to a higher benchmark rate as well as a modest decline in WAC and a modest increase in the default rate assumption. These changes were partially offset by a modest decrease in the prepayment rate. At the end of the first quarter, our student loans were marked at 105.2%, down 40 basis points from the prior quarter. This was driven by an increase in the discount rate due to a higher benchmark rate and was partially offset by a modest decrease in the prepayment rate. The WAC and default rate assumptions remained relatively consistent with the fourth quarter. Turning to our balance sheet. In the first quarter, total assets grew by $3 billion. This was driven by $4.1 billion of loan growth, partially offset by a reduction in cash equivalents, and investment securities of $940 million as a result of using some of our equity to fund loans. Total company-wide cash at quarter end was $3.8 billion. On the liability side, total deposits grew by $2.7 billion to $40.2 billion, primarily driven by growth in member deposits. Our net interest margin was 5.94% for the quarter, up 22 basis points sequentially. This included a 25 basis point decrease in cost of funds, partially offset by a 2 basis point decrease in average asset yields. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 21% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Tangible book value grew $4.2 billion year over year to $9.2 billion, including the benefit from new capital raised in 2025, as well as organic growth in earnings. The tangible book value per share at quarter end is $7.21, up from $4.58 a year ago, a 57% increase. Let me finish by providing our outlook for Q2. In line with market expectations, we now expect an interest rate outlook consistent with the Fed funds futures and no rate cuts in 2026. Now for our specific guidance. For the second quarter of 2026, we expect to deliver adjusted net revenue growth of approximately 30% from Q2 25, which would equate to roughly $1.115 billion. An adjusted EBITDA margin of approximately 30%, which would equate to roughly $330 million. And an adjusted net income margin of approximately 12 to 13%, which equates to roughly 10 to 11 cents of EPS. As I mentioned in our call in January, each year we have seasonal payroll taxes during the first 2 quarters of the year, and we are accelerating marketing expenses in the first half of 2026, in addition to our significant investments in product innovation. This increased expenditure will drive growth in the back half of 2026 and over the long term, and is reflected in our second quarter guidance. Looking beyond Q2, we expect to see continued revenue growth and strong growth in EBITDA, net income, and EPS, which will get us to our full year guidance, which remains unchanged. Overall, Q1 was a solid start to the year. We continue to have strong momentum in our business and are on track to hit our 2026 and medium-term guidance. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, please press star then the number 1 on your telephone keypad. Please keep in mind we'll take only 1 question per person at a time. Please rejoin the queue for any additional questions. Our first question comes from Andrew Jeffrey from William Blair. Please go ahead. Your line is open.
Hi, good morning. Appreciate you taking the question. Anthony, I wonder if you can put a little finer point on the decision process by which you determine how much you want to hold on your balance sheet in terms of personal loans versus the LPB. Wouldn't it behoove the company to maximize platform sales in this environment, hence fee income? I'm just trying to understand exactly what the puts and takes are when you look at that decision every quarter.
Sure. Thank you for the question. We have a lot of optionality when it comes to thinking about how to deploy our capital and how to optimize revenue and profits. Our goal, as we say each quarter, is to drive durable revenue growth through innovation and branding, and to deliver strong returns. And so when we think about the 2 options, if we're going to put loans on our balance sheet, they obviously require capital, and they have credit risk, but they also have a revenue stream that lasts 2 to 3 years as it relates to personal loans. And so that generates really attractive net interest income to us. But obviously, there's a limit to how much we can put on our balance sheet based on our capital ratios and other risks that we're balancing. LPB revenue, on the other hand, doesn't require capital. We're basically producing on behalf of somebody else, and so it doesn't have retained credit risk, and it has the cash flow up front. And so we'll use those, those underlying factors as we think about the considerations. But what I said on the, on the prepared remarks, and what I'd say here is the loan platform volume that we do is essentially the volume that we would not otherwise do for our balance sheet based on all the factors that I just considered. So putting less on our balance sheet may be a driver, and therefore we don't want to underwrite it, and we therefore do with loan platform business. Similarly, depending on what our revenue streams are a year from now, we want more NII in that period relative to cash flow in this period. Some people will raise the question about concerns about private credit. We're not really seeing any issues in our own performance, nor in the demand that we have for LPB revenue and loans from our partners. In fact, we have demand above our contractual obligations that we have on volume that we're producing. But the volume that we put through that channel is volume that we would not otherwise do in our balance sheet because of either our concerns on credit ratios or the capital ratios or credit profile or growth overall in the balance sheet. So it's a good option to have. But I wouldn't think about it as maximizing near-term revenue. It's a balance between near-term and longer-term revenue.
Our next question comes from Dan Dolev from Mizuho. Please go ahead. Your line is open.
Hey guys, really strong results here. Congrats. Chris, question for you. Can you maybe give us some color on the segment level guidance? And then I have a very quick follow-up. Thank you.
Yep, sure. So as I mentioned in our prepared remarks, we feel really good about our 2026 outlook. We're going to be growing 30% top line and delivering 60 cents of EPS. From a segment perspective, as we've said in the past and in any given period, some of our segments may grow faster than expected. Some may be a bit slower, but we're going to effectively allocate capital and resources to the best opportunities that we see in front of us. Given the strong start that we've had to the year, we now expect lending adjusted net revenue growth of at least 30% for the full year of 2026. We expect our tech platform net revenue to be approximately $325 million for the full year. We continue to expect our financial services adjusted net revenue growth of at least 40%. And then we continue to expect corporate revenue to be in line with what we did in 2025.
Our next question comes from Kyle Joseph from Stephens. Please go ahead. Your line is open.
Hey, good morning, guys. Two quick questions, and hate to focus on accounting rather than results, but I get a lot of questions here. Chris, just give us your thoughts. Walk through your accounting on and rationale for capitalizing the market expenses and how you see that impacting EPS and EBITDA. And then just to follow up there, just talk about the JP Morgan facility and the difference between a loan sale versus borrowing. If you could give us some clarity on both those, much appreciated.
Sure. Thanks, Kyle. So in terms of the capitalized marketing costs, at a high level, what I would say is that we sometimes partner with third parties as an efficient top-of-funnel marketing channel where we pay success-based commissions for acquiring revenue-generating money and invest members. This does not include acquisition of our lending or our credit card members. From a high-level accounting perspective, those payments are incremental, and we're only incurring them upon successful acquisition of the member. So under ASC 34040, they're accounted for as contract acquisition costs, which is very similar to capitalized software expenses that drive future revenue. As a result, we capitalize those costs and amortize them over the expected member life to better match the cost with the debit interchange and brokerage revenue that those members generate over time. What's also important is that the amortization is treated as an expense in EBITDA and net income, i.e. it lowers EBITDA and net income. So we're simply aligning the timing of the cost with the revenue that it supports. And then as it relates to the JP Morgan loan sale, prior to September of 2024, we had a senior secured loan on the balance sheet that had no affiliation with JP Morgan. In September of that same year, we opportunistically sold the loan via a special purpose entity to JP Morgan. At the time of the sale, JP Morgan held a controlling interest in the special purpose entity, and SOFI did not retain a controlling interest. At that time, and what is customary with any new loan sales, we obtained an independent third-party true sale opinion as part of confirming that the transaction met the requirements for sale accounting under GAAP, including legal isolation. Based on that, the loan was appropriately derecognized from our balance sheet.
And just want to emphasize one important point about the marketing expenses that are amortized. They are subtracted from revenue, and therefore they do result in a lower EBITDA. Those amortized marketing costs are not excluded from EBITDA. They are expensed against revenue and lower EBITDA.
Our next question comes from Devin Ryan from Citizens JMP. Please go ahead. Your line is open.
Great. Good morning. Another question on loan platform. Obviously good to see a few new partners and expanded capacity this quarter. Can you just characterize the current depth of demand from third-party capital providers and where there's the most interest right now, and also just how that evolved through the quarter, just given some of the pockets of volatility? It sounded like a little change there, but ultimately just kind of what that pipeline looks like. And then on the other side of the equation, would be good to just hear about what you're seeing from customers in terms of personal loan demand, and also how you're optimizing the funnel to move faster on originations or just even improve market awareness. Thank you.
Sure. I'll hit on the loan platform piece, and then I'll let Anthony hit on some of the personal loan stuff. On the loan platform business demand from capital partners, it remains extremely robust. We announced several partnerships last year with Blue Owl, Fortress, and others, and those partnerships are going extremely well. Each of the partners is buying at their contractual level, and even above that in several quarters. And each of our partners who have come up on term in their existing contracts have extended their contracts. In addition to that, we recently signed up and announced 3 new partnerships totaling about $3.6 billion of commitments over the course of the next 2 years. And that comes from a large investment bank, a large asset management firm, and an insurance fund. So the demand that we're seeing is pretty broad-based. It's across asset managers, it's across insurance funds, and several investment banks. We couldn't be happier with the demand that we're seeing, and as Anthony mentioned, it's a great situation to be in, to have the flexibility both on the balance sheet with the capital ratios that we have, as well as the demand that we're seeing from capital markets participants.
And then as it relates to demand, we had record originations in personal loans, in student loan refinancing, as well as in home loans. Our home loans business more than doubled year over year, and I believe our student loan business also more than doubled year over year in originations, and personal loans remains quite robust. We continue to iterate and learn and innovate on every one of our businesses. While these businesses have scaled quite meaningfully, and they've been around and they're long tenured, there's still innovation that can be driven. In personal loans, we continue to find new channels of demand. It is definitely a product that is primarily being used today to refinance expensive credit card debt. And so it's real savings with real amortization of expenses that help people get to a better point financially, and get to the point that they spend less than they make and invest the rest. So it's a really critical product for our members. On student loan refinancing, we had the highest amount of originations that we've had in our history, which is quite remarkable. And it's a product that, again, helps people lower their cost instantly relative to their existing federal student loans or even private student loans at a higher rate. And that's a product that will definitely benefit even more so as rates go down, given the amount of savings they have today versus benchmark rate. That will only improve. The savings in personal loans are dramatic. The savings in student loans are less attractive, but getting more attractive as rates come down. And then in home loans, we're iterating every day to try to get to an outcome that is super fast for our members. We would like to ideally, and I hesitate to say this because I don't know that we'll ever get there, but we're aspirational. We would like to ideally get to a 10-day application to close on a new home, a first lien loan. Getting to 10 days would be remarkable, and it'd be a unique value proposition. Again, we're trying to differentiate each one of our products based on fast selection, content, convenience, and better together. And the home loan product is largely one that I think comes down to speed, ease of use, which can be, a great benefit from AI, which is what we're using to try to drive that faster experience. So strong growth in all 3 products. Credit's performing well, a lot of capital on our balance sheet. We're taking advantage of the opportunity.
And the only other thing I would add, going back to the loan platform business point and what's driving some of the demand that we're seeing from capital markets participants, is just this flight to quality situation that we're seeing. We're constantly hearing from our partners that they're really pleased with the execution that they're getting on our loans, particularly with the resecuritizations that we're doing. We just did a securitization in January that was upsized, and we were able to achieve the best spread that we've ever been able to achieve on one of our securitizations. So I think that's also what's driving some of the demand that we're seeing in the market.
Our next question comes from John Hecht from Jefferies. Please go ahead. Your line is open.
Thanks, guys, for the commentary, especially on the cash-based revenue. First question is, you guys have very good momentum and new member additions. I think it was like 1.1 million, which was a record this quarter. What channels are you getting these from, and are there any changing characteristics of the new members now relative to, say, a couple of years ago?
The characteristics of our member acquisition are in line with where they've been historically. Each business has an individual marketing plan that benefits from different channels. The lending business has historically been one that relies on legacy channels such as direct mail, but it is heavily influenced by affiliate partnerships. Our SOFI Money product is a broad-based digital strategy that we leverage to drive good marketing efficiencies. Our brokerage business continues to benefit from broader selection in IPOs, alternative assets, private offerings, in addition to single stocks without commissions or robo accounts in our ETFs. And that, again, is really an affiliate and digital marketing channel acquisition product. Crypto is the new kid on the street, and we're developing new opportunities for marketing there. I would say when we launched crypto in a really fast get to market, if we didn't have the technology platform business, there's no way we'd be able to launch crypto, buy, sell, and hold in such a short time period, or SOFI USD. And so we benefit from having that platform. That's something we haven't marketed aggressively yet. We wanted to make sure the product was scalable and one that was meeting the needs of our members, and we have that confirmation now. So we'll continue to benefit from increased awareness of SOFI crypto impacting the P&L. Our credit card business is actually doing pretty well, and we're excited about the changes that we've made over time. We're starting to see people transition from balance transfers with 0 APRs to actually paying a full APR at a reasonable rate. And so that's contributing to the numbers that we reported this quarter, both on the interchange side as well as the revolving side. And then our debit interchange, the amount of debit interchange we're driving today is quite significant and scaled, is also contributing. And when we talked about the $390 million of non-interest cash revenue, it's now large enough and scaled enough that it's contributing to the overall business, and the marketing that we can put behind it is scaling as well. The last product that I'll mention is SOFI Plus. We launched SOFI Plus in January of 2025. And it wasn't that great of a product at first, but like with most things we launch, we learn, we iterate, we learn, we iterate, we learn, we iterate, and we relaunched it on April 1. It's doing phenomenally well. We're pretty excited about it. It's meant to be a product that's the best of SOFI in one subscription product. It's $10 a month. It's more than $1,000 of value. It's primarily a product our existing members are buying. And not only are they signing up for that product, and it's going to generate a recurring revenue stream, kind of like the net interest income that we have, that's very visible and recurring, but moreover, it's driving cross-buy. 50% of the people that sign up for SOFI Plus, which again are largely existing members, take out another product. So not only does it drive the direct revenue stream, it's driving additional cross-buy and building awareness of us being an everything app in financial services.
Our next question comes from Kyle Peterson from Needham. Please go ahead. Your line is open.
Hey, good morning. Appreciate you guys taking the questions. Wanted to dive a little more into the tech platform. Appreciate the segment guidance you guys gave, but I guess I just want to see if you guys give any more granularity on how the year should unfold there. I know you guys have several partnerships and product wins from last year that should be going live as the year unfolds. And also have the refresh. So just want to see like how the year should unfold and what the different puts and takes are to to get you guys there from the 1Q run rate?
Sure. Chris gave you a specific guide for the year on revenue. Clearly, the business revenue was negatively impacted by the loss of one large customer, which we've talked about in the past, so that shouldn't have been a surprise. The tech platform revenue, if you do like for like on a year-over-year basis, was up about 12% year-over-year. We expect that the year-over-year growth rate on a like-for-like basis to accelerate throughout the year, both from our existing members' growth as well as new partner adds. We mentioned in the prepared remarks that we have 13 new partners that have launched in Q1 2026 and generated revenue in Q1 2026 that were not generating revenue in Q1 of 2025. So that revenue will scale over time. It doesn't come instantly. We also have one partner in the quarter that has an existing installed base, and so that's contributing. We have another integration that will take place throughout the year of a large installed partner, a partner with a large installed customer base, which will generate revenue as well. One of the things that may be hard for people to understand is the significant benefit that we have from owning the technology platform on our own innovation. Obviously, the resources there aren't unlimited. We made the decision last year to build out crypto buy, sell, and hold, made the decision to launch SOFI USD. Those products are launched and they'll start to generate revenue in 2026. That will be incremental, but they definitely used resources that would otherwise be used for other partners and other services. We're excited about the strategy that we have in SOFI Technology Solutions and the 4 areas being processing, core banking and ledgers, payment hub, as well as risk platform. And that go-to-market against those 4 products will help us build good sustained growth. And our objective is to get back to 20 to 25% compounding growth over the years to come. This is obviously a year in which revenue is going to be disappointed because of loss of that large customer, but we'll try to continue to outperform it and deliver on the numbers that Chris shared with you earlier.
Our next question comes from Pete Christensen from Citi. Please go ahead. Your line is open.
Good morning. Thanks for the question. Anthony, I'm just curious how you're thinking about where we are in the credit cycle generally. Obviously, credit performance was pretty good this quarter, with the backdrop of certainly higher tax refunds this year. I guess there's some perception that some underlying data that's pointing to things could get a little bit more challenging later this year, given geopolitical macro stress. Just curious on how you're planning business around some of these perceptions. Thank you.
Yeah, credit performance has been strong as we reported. We have a early warning dashboard that looks across a number of macro and microeconomic factors in the performance of our own loans as well. And if that turns yellow and then red, we reduce the tiers that we're willing to underwrite. We're not in that situation in any way, shape, or form. The current loans are performing well. The macro is also continuing to perform well. And not only are we seeing the strong trends in our own loans across the 3 that we operate in, we're also seeing strong demand from loan platform business buyers and otherwise more broadly. We have a lot of capital on the balance sheet. We have the flexibility to meet the demand from the consumers. So you have the combination of strong demand from consumers plus strong performance in credit and adequate capital. We'd be nuts not to be able to meet that demand and hold some of it on our balance sheet and continue to generate increasing net interest income. As Chris talked about, we had $690 million of cash net interest income, and we want to continue to grow that. It's a great baseline of revenue that allows us to invest aggressively because it's super profitable in these other areas, which helps build up the other revenue stream, which is the non-interest cash revenue of $390 million. And for those that aren't familiar, that $390 million reported in the quarter represents the interchange from debit and credit cards. It represents the fees from loan platform business, our technology revenue, our brokerage revenue, and our referral fee revenue, as well as origination fees that consumers pay us. And it's a cash number.
And our last question today will come from Don Fandetti from Wells Fargo. Please go ahead. Your line is open.
Hi, good morning. Home lending, is obviously a large market, and you've had some growth there. Would you consider doing anything on the acquisition side, sort of building on what you've done in the past? And if not here, where would you look for potential acquisitions?
The M&A market is very vibrant. There's a lot of assets for sale. We're remaining disciplined and looking for things that can help us accelerate strategically. We feel like we've done the right acquisitions in home loans, that's not an area that we're currently focused on. It's really driving organic growth and continue to optimize the operation to quickly meet our members' needs. We're still investing a lot in home loans. As I mentioned, the business more than doubles from origination standpoint year over year. So we're doing a much better job meeting the needs of our members. As it relates to M&A more broadly, I would say we're prioritizing things tied specifically to SOFI Technology Solutions, the technology platform business. We've talked about the fact that we'd like to have revolving credit processing as well as a core tied to that. As we mentioned in the prepared remarks, on July 1, we will launch SoFi Bank on a new modern core as well as Ledger, and that will unlock a lot of other capabilities that we'll bring to our partners, including simultaneously launching big business banking with an API format and an exchange network for fiat and cryptocurrencies. And so the areas that we would probably prioritize from an M&A standpoint are really in the technology space, specifically revolving credit as well as crypto and blockchain services. We want to build out the same infrastructure services that we have in fiat and crypto. So staking as a service, stablecoins as a service, wallet as a service, et cetera. Great. Thank you all. Thank you all for joining today. I want to end with a closing remark. If you've taken anything away from today's call, please take away these key points. Our strategy and execution continue to be unmatched by any company I can think of at our scale and put SoFi in a class of one. We've achieved 18 consecutive quarters of exceeding the rule of 40, far exceeding it again this quarter at 72, with 41% revenue growth and 31% EBITDA margins. When other companies are stumbling, our revenue growth is accelerating. Most importantly, we generated more than $1 billion in cash revenue, with $690 million in cash net interest income paid to us by our members, and $390 million in cash revenue from debit and credit card interchange revenue, tech platform revenue, brokerage revenue, LPB revenue, referral revenue, and origination fees. These non-lending businesses, which do not require capital and are lower risk, were in their infancy only a few years ago. But now they have reached the critical scale to meaningfully contribute to overall growth and profitability for years to come. Our focus remains on executing to ensure we're iterating, learning, and innovating like never before to generate escape velocity and delivering on our mission for our members. Our goal is to have the greatest impact on our members of any company in the world, and in doing so, we will be the winner that takes the most in driving value for our shareholders. Thank you for joining us today, and we look forward to seeing you next quarter.
Goodbye. This concludes today's conference call. You may now disconnect.
All right. What is everyone thinking after that? Holy. Let's go around the clock. Roy, how was that, brother?
I'm still digesting it, but yeah, like the couple of things. Tech platform, not an aberration. 75 million. They said 325 million for the year, so it is what it is. If your thesis was AWS a fintech or tech platform is going to accelerate, that thesis is not happening.
Mm-hmm.
I still have some questions, and I need to go back over the call. I'm more of a visual guy, so seeing the transcript is helpful. But I appreciated the color on.
I was posting most of the transcript in the chat. I was trying to.
Yeah, I saw the quotes. That was helpful too. Yeah, it was helpful to try to understand, and the analysts asked some really good questions here as far as like the mix shift between lending themselves and the thought process behind that versus the loan platform business. Doesn't seem like that they're seeing any weakness on that front as far as consumers or from demand on the loan platform business side. So those were both good reads as well. But yeah, good call.
Tevis?
Yeah, the tech platform number was the thing that I stuck on as well. I mean, if you take out the 75 million that they did this quarter, 250 for the remaining 3 quarters, 83 million in revenue per quarter, like, this thing is going to be down all year on year, from the 100+ million that they were doing in revenue in 25.
Yeah, Chime was a big client.
Well, okay, so this is what I was thinking. Like, how big must Chime have been for them to sign 13 new clients and still be so like crazy down year over year. That
Well, I think they said something like they signed 13 new clients, but then Noto also said like one of them has an install base.
Yeah, and they would scale throughout the year. So sure, but it's still very significant where 13 clients and some with installed bases still can't make up that gap for Chime, that they're going to take over a full year to close that gap.
No, I was actually saying that as more of a negative thing of like only one had an install base.
No, he said multiple had an install base. I have the quote here. We have one partner in the quarter that had an existing install base that's contributing. We have another integration that will take place throughout the year with a large installed customer base, which will generate revenue as well.
They said they got 13 new deals that produced revenue this quarter, and one of them has an install base this quarter.
Yeah, so they're smaller deals.
Yeah, tiny, like tiny deals. So, yeah, I mean, it is what it is. But I also think I was kind of thinking of it as being like a data center company. You know, you have companies like Azure and Google and stuff, and they can use the amount of compute themselves, but they also have a division that sells off that compute. Meta is not selling off that compute. They built it all internally for their own needs. And it's like, what would you want SoFi to do with the tech platform? Would you want them to do what Chime is doing, which is to build a tech platform purely for themselves? Or would you want them to build a tech platform for themselves and then sell off what's left? And I would prefer the latter. You know, if they can get $300 million of revenue, sure. Are they the AWS of fintech? No. We haven't heard that quote for years because the dream had died a long time ago. Like, they knew that Chime was wanting to leave the platform for years. They knew Vero and Current were leaving the platform for years and years. So they've been talking about how it's affecting how fast the product cadence can happen. And that's also exciting. But I would look at anything extra past that as just, you know, the cherry on top, not the actual sundae. Neil, what did you think about the quarter?
Yeah,
the call specifically.
Yeah. Also, I was also reading back on that comment from the install base thing, and look, it's like Teve said, it's quite interesting. Like Chime leaves, and you get 13 extras, or not really extras, but it's basically a part of the business where we just have to say, you know what, forget about it. It's going to be there. It's going to add a little bit of revenue here and there, some contributions, profit as well, and that's about it. And then if they scale faster because of the new name of the product, whatever, fine. But it seems like they are now using it more to make their business grow faster and better, launch new products, which okay.
Which is perfectly fine.
Yes, it's perfectly fine. Also, the fact that they do have a struggling business like the tech platform, or maybe they should change that name all in all, and they can still grow 40%, 41%, doubled EPS right now, stay expected to grow nicely this year, is quite good to me, right? I've seen already some people comment about, oh, I thought this was a tech stock, blah, blah, blah. Like, does it really matter how we name SoFi if it grows 40%? Like, you're getting a higher multiple because you're growing fast and they're also becoming more profitable, which is also a good thing. And yeah, I don't know. It's show me banks that grow 40%. You will not be able to show me any bank that grows 40% while also becoming more profitable.
Yeah.
But yeah, it is what it is with this tech platform thing. I'm sure they already figured it out internally that, you know what, let's just use it to make our business better and move faster, and then we'll see whoever wants to buy some of our services from it.
Yeah, I think overall, I've been more interested in SoFi Bank than I have the tech platform. And the KPIs that I want to focus on is average revenue per customer, products per user, customer acquisition costs, total members. And a lot of those did very well this quarter. They said that although they're adding 1.1 million, roughly, new members this quarter, it's the same targeted customer that they've been looking for. The high FICO, high income. They've been able to cross-sell into great products. Those products are individually doing very well. SoFi Invest actually killed it. Like they grew a lot and revenue was up 100% year over year. And I would say that the environment for trading between January to March was not as strong as last year. Like, so they're growing well in that space. They're growing well in credit cards. They're growing well in a lot of the financial services products. And year over year growth, even with the tech platform putting up such disastrous results, was 41%. So while people are in chat being upset because the stock is down, which I understand, like trust me, I'm there. You know, you have to look back at what are we buying this for, and is it quote unquote? I see this comment a lot in chat as it's flying by. Is it's just a bank? It's like there's no other bank that you're finding growing 40% with a PEG ratio under 1 times. You know, so it depends on the metric that you want to pick out, but. That's why they're showing off things like cash revenue this time. Put it up against any other business. Are you growing at this rate? Can you put up 72% Rule of 40? And if you can, and you're growing by more fee-based revenue, then it should get a multiple.
Do you guys honestly think we're not getting any cut this year? Because I think we're going to have one. I know they're guiding for 0 cuts, but I think we're definitely going to have one. It's probably just like new Fed chair. They're playing it overly safe because, like, who knows what's in Kevin Warsh's head. But I think we're going to end up with a better scenario where we do have 1 rate cut at some point, and then they have a quarter where they really beat. Because Q2 guidance is not even that strong, considering the EPS that they have for the full year 26. If you just do the math, they're like backloading a lot of their growth.
Yeah, so it depends on this. So it's not just oil. Oil over 100. It's not bullish on rate cuts. Gas prices, especially TTF in Europe, that being elevated, not bullish for rate cuts, and it does have an impact, less or so, on the United States. This is another area. You know, I mean, there's a lot of them. Like helium, I think 25 to 30% of the helium comes from Qatar. They're not able to get that out right now. Urea, which you're like, who cares about urea? This is fertilizer, and as there is less that's actually being shipped, it's one of the components of several different fertilizers. What happens is, the prices of fertilizer are higher, and as a result, 2 things happen. There's more cost for those that are, planting grain and all sorts of different those type of commodities, which adds some pricing pressure to the upside on that. But the other factor too is oftentimes in some poorer regions, they're just not able to pay that higher price for fertilizer, so they use less, and as a result, the yields drop down. So it's a double impact in terms of what happens on that type of commodity as far as food. And then you have the transportation cost, which is higher as well because oil is higher. So if this is resolved fairly soon, and again, they need to get the fertilizer in the ground, like in some of the regions like now, fine, we will probably have a rate cut. If we don't for a few more months, probably no rate cuts is correct. Yeah.
With the new Fed chair, it's always like the market's going to test that. We'll see what ends up happening. But yeah, a lot of people are also talking about selling. I'm curious. Let's do a poll in chat. If people are potentially changing their mind on this stock, I know, what's really funny is like we're talking about this stock going from 1836 down to 1650 right now in trading, and everyone's talking about like this company's going to 0. Like, guys, we've held this through $4. Like, do you think 16 bothers me? Our average costs are like $8 a share. Like, it's
but Tanner, you don't understand. Everyone bought it at $30.
Yeah,
everyone bought it at 30. Nobody bought it at 10 or less.
I know, and they bought it at 30 and they sell at 16. Like that's classic retail behavior. It's like when can we buy whenever everyone else is excited, and then when can we sell whenever everyone's so scared? It's like the opposite of what they tell you to do. But yeah.
But Tevis, you brought up a good point actually with the 8 cents EPS in Q2. It means Q3 and Q4 are supposed to be huge quarters.
Yeah. So Chris Lapointe said it would equate to roughly 10 to 11 cents of EPS, the adjusted net income margin, which is 12 to 13%. So if you just do the math, 13 cents in Q1 and let's say 11 cents in Q2, that's 24 cents of EPS in the first half of the year. If you subtract 60, which is the full year estimate, that would leave you 36 cents of EPS for the second half of the year, which is what, 18 cents EPS for Q3 and Q4 respectively. That's a big step change.
Yes.
Roughly 15% of the poll right now is saying they are selling after this report.
Yeah, in mine, it's very few votes, 0 selling. Most it's flipped between holding and buying. So I got more SoFi bulls. It's because I'm wearing the SoFi kind of blue. So
that's SoFi blue. Looks like it to me.
It's the closest I have. So I'm like, let me put it on.
Yeah.
I think the last time I made one of these calls, I was just trying to not wake up my wife, so I just grabbed whatever shirt was on top. It was red, and I'm like, well, I'm not making that mistake. So I laid it out early, guys. Didn't help the share price, but yeah. Yeah, for myself, like some people are asking, what are we doing? I'll just share for me. It's continued hold. If SoFi had a killer quarter, the stock price was up meaningfully. Some of my SoFi position is in a swing bucket, and I would sell those shares very specifically. But my core shares, I've not sold any yet, and I've just added to. So we'll continue to hold. I think it's mispriced even here. Not the best report. There is some weakness here, but end of the day, 41% revenue growth. Very pleased with that. It's a little different, quarter than I expected as far as how that revenue was contributed to, and as far as a little bit on the guidance side. But yeah, very good company. It's an easy hold for me. So
yeah, I'm holding. I don't know if I'm ready to add just yet. I mean, whenever you look at even recent prices, like what was it, March 30th, we were under 15. There's been some definite chances to add around these prices in very recent times. And although we've run up, we're just coming back down to those prices that we saw, a couple weeks ago.
$20 2027 leaps look quite attractive if we do stay in this $16 range.
And what's the math on that? What's the price?
What did I see? Let's see. Because
it'll be more telling after the market opens up, but
because I checked a couple of weeks ago because I saw TJ, the wheel deal, talk about it. I checked the December 2027 $20 calls, and they were not that expensive at all. I'm like, okay, if by then you're not well above $20, then something went wrong. But I guess we'll have to wait until the market opens to see what the new price would be.
Something going wrong, like the tech platform losing their biggest customer.
I mean, but even with that, the other part of the business is doing all of the heavy lifting, and then some. Like 4 years ago, the lending part of the business, which was SoFi, let's be honest, was supposed to be dead, and now it's the biggest part of the business. So it's not like this is a business that never faced any headwinds. This business was supposed to die in 2021, 2022, and we are much, much bigger today than we were before, and profitable.
The problem is also we're not in a market alone, right? This is one of the problems that I think people are having, is that they're having like this thing where like their neighbor is getting rich and they're not because they're in the wrong stock or something like this. And so Bloom Energy is up 24% right now in after hours. And SoFi is down 10%. So SoFi being down 10% alone, as if they reported alone, you might be able to stomach that. But the fact that other people have done really, really well makes it very hard to hold one name and not the other. This is why potentially you don't go all in on one name. But yeah.
But on the other hand, Robinhood is also down 10%. So now we cannot have this fight of, Robinhood is much better because it's up and SoFi is down. No, they're both equally bad, apparently.
Yeah, we're in solidarity. If your name is not aligning with Anthropic or the AI trade, then you're sitting here and waiting.
Yeah,
But
and this is like if you're comparing the two, which there's some overlap, but this is a better quarter for SoFi than it was for Robinhood for sure. Like I don't think you could look at it and say otherwise. And I'm in both. I hold both close to equal weight, a little more Robinhood.
United in pain, yeah.
Yeah.
I mean, definitely on
Solidarity.
the brokerage side, like, dude, SoFi skyrocketed like 100% year over year. That is the part that's most equivalent to Robinhood. They dominated Robinhood there. That's kind of interesting. And then on the originations, which did really well, like there were some comments too where they said like the loan platform business, we had so much demand that we didn't even fulfill it. I thought that was interesting. Like usually, you see that on a Nebius or something like this where it's just like skyrocketing in growth. I don't know if you see it that much on quarters that are potentially in line. I'm curious what your guys' thoughts are. Like, do you believe that the loan platform business is just skyrocketing in demand and they're potentially wanting it in their own books and stuff like this?
I mean, if you take management's word, like what I don't understand right now is like management's word and the numbers aren't aligning right now. Because on one hand, they're saying we're seeing overwhelming demand for LPB, more so than we wanted to fulfill in Q1. And then on the other hand, they're guiding for like 10 cents of EPS next quarter. So I'm like, all right, that's less than this quarter. So what's not like? I understand the idea of saying, oh, the economy is more uncertain and softer today than it might have been in January when they did the full year guide. I get that. But at the same time, they're also saying the demand for our loans is super strong. And so you would imagine that if the demand is super strong, then that would reflect in the guidance. And it does in the full year guidance, but it doesn't in the next quarter guidance. So are we expecting some like short-term headwinds that they're not talking about on the call? Because I'm just trying to put two and two together here and it's not making sense to me.
What is the next quarter? I know the growth rate, but what's the actual number? Adjusted net revenue for next. Oh, sorry. No. Let me just do the math.
330 million adjusted EBITDA and 1.11 billion in revenue is what LaPointe said. I don't have the thing in front of me, but here it is. Adjusted net revenue 858 million. Tanner.
No, that's last year.
Oh,
it's 1.115.
Yeah, 115 and 330 is the adjusted EBITDA. So 10 cents to 11 cents of EBITDA of EPS.
Yeah, I mean that's not bad, dude. Like that's continued growth on the quarter, and then if they can come in and beat that, then that's nice.
We also have to remember that we grew a lot year over year right now. That's also because last year's March quarter was only a 19.6% year-over-year growth quarter. Mm-hmm. We are now lapping, we're going to lap a 42.8% quarter from last year. So that 30%, if people are freaking out, we're going from 41% to just 30%. Just remember, it's a much tougher year-over-year comparison.
Harder.
Yes.
Yeah.
Also, lastly, remember when everyone was complaining that they raised at $27 and something? I'm sure we're all quite happy that they did that at $27.50 or whatever the price was and not at $16, $17 right now.
Yeah, I was always fine with that raise. The first one is, but yeah, that's watering the bridge now. Yeah, like the loan platform business comment is interesting. Just looking into this, that was one of that was like really one of 2 points that was raised in the short report that I had questions on, just because we saw weakness, and I think it did pressure the share price for SoFi related to private credit specifically, and whether or not the demand would be there. A loan platform. We had an early answer based on those new agreements for securitization and partnerships for loan platform business. And then we had another answer here as well, that the demand has exceeded the supply in this case. which is interesting. I'm curious as far as like it seems like that there's more interest there for SoFi, and I wonder if the dynamic of that was just SoFi's like, hey, we know that you want all these products, but we want to issue a little bit more loans here. We see an opportunity, but a little strange. Not what I was expecting. Now, the one thing that I was looking at as well, and I mentioned this with Tevis on Friday, around 25% historically of private credit has been invested in SaaS, specifically just because it's been very dependable as far as revenue growth, as far as seat-based revenue expectations, a high margin product, and deemed previously high moat. We've seen, of course, that hit private credit quite substantially. So I'm kind of curious if part of that demand is just a mix shift in terms of what private credit is willing to allocate to SaaS versus non-SaaS names, which would be to the benefit of the loan platform business. So something to keep an eye on.
We're going to stick around for 5 more minutes to see the market open. Where do you guys think it goes from here? Obviously, we're already down, 9%. Do you think we fall further, or you think there could be potential green candles from the negative 9%? Let's do a poll on that, actually. So going from, I'm not saying from 1836, we're definitely going to be red. Do you believe, because Lending Club went, their quarter was crazy. Actually, let me show you what that looked like. Whenever they reported earnings, they skyrocketed up like 15 or 17%. And then once the report actually, or the market actually opened, they just fell right back to where they were almost immediately. So this massive like 17% move was purely in after hours.
I think we're going to trade down for the first half of the day as the market opens, but I think that we close that gap towards the second half of the day and anticipate like the entire market is going to go back up in anticipation of the mega caps after hours. So I think SoFi is going to get dragged up in the second half of the day as a result of that.
Don't forget our friend Jerome is speaking today.
Yeah,
that too. And Anthony Noto is going to do the rounds on all the major, news networks as well, talking about their earnings. So
hopefully,
yeah. And analysts will come out with probably not a whole lot of upgrades here, but just because guidance stood pat, but that also weigh on it. But yeah, I wouldn't be surprised if we are a little higher than where we are right now at the end of the day. But on open, it may not be the case.
Yeah, seriously. Okay. Let's see what people are polling in chat. And hopefully we'll have all my numbers plugged and everything, and then I can get a better opinion on the quarter once I actually see the whole thing in my spreadsheet. It's also important. But yeah, tech platform, not I don't even know if miss is the right word, because I'm sure they saw it. And if you guys know, Chime was actually expected to drop off the platform in Q1 of 2026. It dropped off the platform early in Q4 of 2025. I'm curious if many of the customers, like the 13 new customers and everything, were expected to offset a little bit of that, and then because Chime paid early, it kind of changed the math on that, and so Q4 was like a big bump in tech, and then a big sell-off in Q1. I'm not sure, but the market's about to open in about 1 minute and 10 seconds. What did you guys say? You guys think it's going to open green or red from here?
I agree with Tevis. Probably spike down and then recover towards the end of the day.
Gosh, can you imagine we get like a negative 15% day or something?
Yeah, I mean, we could see that at the open. I'm not.
You could definitely see it.
But I gotta go, guys. I have a 9:30. Appreciate all of you, and good luck throughout the day. See you guys.
Thanks, brother.
See ya.
See ya.
I mean,
what do you
futures, pre-market were green, so that could help us a little bit. Because if pre-market everything was red, I guess down 15% would be the usual stuff. But in this case, maybe we open down 12 and then we rebound a little bit. It's possible.
Well, we'll find out in 5, 4, 3, 2, 1. That's not a good start. Yeah. Potential continued sell-off. Classic SOFI.
Classic SOFI would be from green to red. Now we're hoping from red to less red.
Yeah. Classic SOFI would just be a flip of whatever we were doing pre-market, I guess.
Yeah, one of the silver linings though is like if you had a absolutely stellar report in the morning, it's awesome, it's amazing, but that would be utterly forgotten in the after hours just because there's so many massive hyperscalers that are reporting this evening. This was not the best report. It's not terrible. 41% revenue growth is very good. But it's the focus on it will have definitely shifted and moved on to the hyperscalers, which is okay.
Bloom Energy is up 25%. Seagate up 19%. And SoFi's down 11.5%.
What about Robinhood? Also, probably the same.
Hood is Lending Club's even down 3% today. Hood's down 11%. Look at these. We're twinning. Twinning
PayPal
with
is
Robinhood.
flat. PayPal is flat, ladies and gentlemen. How the tables have turned.
Well, they report next week, but yeah, rooting for bulls. I'm not in it, but yeah.
Dude, if somehow big tech sells off tonight, I'm gonna freak out. I don't see that happening.
What do you
AI
expect?
trades have been really good lately.
What do you expect from tonight? Like raised capex, questions about capex, reductions?
Yes, slight raises of capex. Like if Google, I think they're 165 billion to 180 billion. Or 185. I think we might see like a 170 to 190. Slight shift up.
Big announcements, you think, or just business as usual?
I don't know. I don't even know what I would expect from big announcements other than just like, I think a lot of the press releases and stuff that we've seen are what they're going to talk about. Amazon's going to talk about their deal with OpenAI. Google's going to talk about recent deals with Anthropic. Like, we're just going to see a lot more of that. But I think it's going to be more demand than we could ever imagine supply.
Yeah.
Across 3 of those companies. And then Meta's going to talk about how they are buying all that supply.
Yeah, the one thing as far as the capex, I think that'll be under focus and ROI, and I think Amazon might come under the most scrutiny. Last time they had to do a raise to support some of the capex expansion. Market seemed to not like that. Shareholders seem to not like that as well. Even though, I mean, it makes sense for what Amazon's doing and building, but right now the market has not been in the mood, or at least wasn't last quarter. Outside of the rest, like should be very strong reports. The market reaction could be anything, but.
Dude, when's the last time you've seen Visa of 10%?
Yeah, it's pretty wild.
Or FICO was doing really well. That's kind of come down a bit.
Yeah, I wonder if buybacks is the main driver of the Visa thing. They did expand it, and they had a good report, but yeah.
And just a general big double beat. Like EPS grew by 20%, revenue grew by I think 17% or something like this year over year. Like that's huge for Visa.
You also said something about, what was it, record volume or something?
You would need to, right? If you're beating revenue by 7, or if you're growing revenue by 17% year over year, that would need to be volume based, right?
Okay, I guess stable coins are not destroying the business.
Nope. Yeah, that was a funny narrative last year.
So 12%. Okay. Down 12.
yeah, nothing too crazy.
Was that the bottom 1593 on the day?
I mean, like depending on macro, like honestly, there's a lot happening with Iran right now, and of course with the Fed, and then ultimately like with the hyperscalers. But yeah, it wouldn't surprise me if that's the flush. I mean, oftentimes there's just people that will not sell or will not buy in the pre-market, and so you always see that big volume spike, and people will make the moves if they will based on the report. So, not too surprising that we get that, and then buyers usually will step in at that point too. But we'll see.
Yeah, it usually feels like I've been seeing a lot of times, especially recently, where the immediate 5-10 minutes of whenever the market reports is the most volatile, and then the market seems to figure out where they want to settle at, and so. That's why I said like this could be read down 15%. We could just see this large spike right at the beginning, and then find out where we want to go from there. But yeah. Okay, SanDisk is up $75. That's crazy. Have you guys taken a look at the 1-year chart on this stock?
Yeah, it's insane.
3,300%. It's a 34x.
They report tomorrow.
Micron, should have listened to Neil earlier. Much earlier. But I did get in, just it's much later.
Yeah.
Lemonade is down 8, actually.
That's why Tevis turned his camera off midstream. Or why he had to go at 9:30.
Nebius is up though, so yeah, VG's up 3.5.
Okay.
Today is a good day. Today is a good day. I
is it?
Feel it. Yeah, it cannot get worse. Or could it? I don't know.
You know what? You're a glass half full kind of guy, eh?
It really depends. I'm saying this just because it's sun is out. There's not one cloud here. It's perfect weather.
Yeah,
makes everything makes everything much better.
Yeah, your stock falls by 12%. You're like, I guess I'll put the phone down and go outside.
Yes, maybe play some golf. It's always good.
Yeah. All right. Ladies and gentlemen, let's hope that 1593 was the bottom and potentially we climb back from there over time. But yeah, I honestly think SoFi is going to be range bound. Not a tight range. I just mean like we're not going to be breaking new all-time highs until we start seeing some better macro environments. We need rate cuts. We want wars to end. We want the market to settle. And SoFi, just like last time, whenever we were sub $6, they're going to continue to create a better and better springboard for whenever that pop does happen. More members, more customers, more ability to lend. But until that macro environment shows signs that either the rate cuts are off the table, or sorry, rate hikes are off the table, or potentially 1, 2, or 3 rate cuts are coming, we're going to be, probably sub 20 or sub 22 or something like that for a while. Unless you guys have anything to add to that, we'll wrap there.
Yeah, I'll just say,
sounds good.
Good company, bad stock for now, but the good company part is the most important.
Very true.
Yep.
All right. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But until next time, bye for now.